So guys, today we'll be starting with consolidated financial statement revision. Even though the chapter is lengthy, conceptually when you are trying to learn consolidated, not actually is from the basic why we do consolidation, and in the process of consolidation, what is happening to both the balance sheet, parent and subsidiary. Overview, if you understand, then all the adjustments will appear very simple to you. And next is how to present the thing you are solving in the final exam. Like what order you have to think, what order you have to do adjustments, these kind of things. Adjustments wise, consolidation will not pose you any difficulty at all if your basic part is there. So let's start with consolidated. Now, the story comes like this. We have a standard Ind AS 103 deals with this combination. As per this standard, when one entity obtains control over business of another entity, then this transaction in which control is obtained is referred as an entity is obtaining control over business of another entity. Then this entity has done a business combination transaction, and any business combination be done in accordance with AS1 accounting. So Ind AS 103 not cover it yet, after the consolidation part is over for our examination. Now, when X Limited was an existing company, Y Limited is another existing. X Limited acquired, let us say, 80% shares in Y Limited. When X acquires 80% shares in Y Limited, major voting power, controlling power is now in the hands of X Limited. But Y Limited is not shut down. Y Limited is still existing legally. This X Limited is referred as the parent. Y Limited, it is under the control of the parent. We refer it as, and even though Y Limited as a legal entity, it is not shut down, it is still operating, but all the decision making power of Y Limited now came into the hands of Limited. It's called as acquisition of. In this transaction, by purchasing shares in subsidiary, parent company acquired control. This also qualifies to be a business combination. This is a parent subsidiary relationship, but prima facie is a business combination. And now that it is a business combination, AS 103 will tell you how to measure the assets and liability, how to compute purchase consideration, how to account for indemnification, how to account for intangible assets. There are so many issues in Ind AS 103. Ind AS 103 tells you so many points. They just give you so much guidance as ultimately they want to correctly measure this. Or will transfer it. There is no direct methodology of working out goodwill or capital. In your basic level, you might have studied super profit method. All there is like that is wrong. That's not how you measure. The way of measuring is measure the entire entity ka value and measure individual assets and liabilities which are identifiable. Take the difference. Whatever could not be explained, that is called as balancing. There is a correct way of identifying correct answer. So this methodology is given in AS 1. So that part if you keep it aside. Now, legally what Companies Act says, when one company obtains control over another company, that other company ka business is also happening under my decision making power. So some businesses or some decisions or some action, you instead of doing it in your own company, you may do it in the name of Y Limited. Now, it's possible. Therefore, for shareholders' point of view, if they want to get an overall picture of your affairs, transaction and position, it is compulsory that you have to prepare a consolidated. Companies Act mandate. Who has to prepare consolidated financial statements? The parent company has to prepare consolidated financial statements. Without preparing consolidated financial statements on its own, also on standalone financial statements, they have to prepare. That is referred as separate financials. You have preface and status. Now, if you want to do consolidation, then a consolidation how to do on the guidance is given by Ind AS 1. Already Ind AS 103 is there, which will tell you how to compute purchase consideration, at what amounts you should recognize asset liabilities, how to determine goodwill, NCA how to compute. All these discussions coming in which standard? Ind AS 103. What is Ind AS 110 telling you? Ind AS 110 will tell you how to do the procedure for consolidation. Separate financial statements. Without preparing consolidated financials, if X Limited releases their own financial statement standalone, in that the investments that it has in subsidiary, associate or joint venture, at what amount you have to measure, that guidance is given in Ind AS. So one standard we have seen, Ind AS 103, now 110 and Ind AS 20. Now, if this X Limited, instead of having a subsidiary investment, if it has an investment in associate or joint venture, has investment in associate or joint venture, then also it has to do consolidated financial statements. But in this case, the consolidated financial statements have to be made in accordance with guidance in the consolidation procedure what we follow in case of subsidiary, and the consolidation procedures what we follow in case of associate or joint venture, they are completely different. For subsidiary, we will do something called as a full consolidation. For associate and joint venture, we will do something called as an equity method. So, even though we don't do full consolidation, the financial statements are referred as consolidated financial statements. Even though you simply apply equity method. Now, how to apply equity method is given under Ind AS 20. Next, if you ask me, sir, what is the meaning of associate? Given in Ind AS 28 only. Sir, what is the meaning of joint venture? The meaning of joint venture given in another standard called as joint arrangement. In these joint arrangements, we have two types of joint arrangements. Joint operation, one is joint venture J. If it is JV, then only consolidated financial statement. Consolidated financial statement has to be prepared in accordance with AS. If it is JO, then Ind AS 28 is not applicable. Then also you will do consolidation, but that is called as proportionate consolidation. Which standard deals? Ind AS triple. So whatever you are seeing, use various standards, and in what context which standard is to be applied. First of all, prima facie there is a business combination transaction. If it is a business combination transaction, then only parent subsidiary relationship will get established. Because it's a parent subsidiary relationship, you have to do consolidated financial statements in accordance with the law. If you have to do consolidated financial statements, then you have to apply Ind AS 110 for understanding the procedure for consolidation. Without doing consolidation, your standalone financial statements are referred as separate financial statements. For that, one more standard Ind AS 27 is there. In case you don't have a subsidiary, you have an associate or a joint venture, which arises because of significant influence relationship or joint control relationship. In that case, also you have to do consolidated financial in accordance with Ind AS 20. To understand what is joint venture, you have to read a standard called as Ind AS triple called joint arrangements. That JO, JV2 categories are there. If it is JV, then only Ind AS 28 is applicable. If it is JO, Ind AS triple one, the proportional consolidation method. The overall snapshot of various standards we have. The book also have given this form of a chart here. Which standard, when it is applicable, who is covering what? Page number 28.2 you can see standard applicable for this and have this. So this will just, once you finish up the entire reading, each chart is useless for you because usually you know the standard itself, but initially the overall. Theory part we will study later on, sir, means where exemptions are given, what is control and all, that's not really important. We will first focus on practical numerical. Listen, A Limited purchased 80% share in Dividend on 1/4/2020. Since they purchased investment, normally A Limited Things that the business combination transaction, we have invested in equity shares of another entity, that another entity is B Limited is an acquiree, but since I have control over that, B Limited is called as, and we are referred as debt. So from a crude consolidation point of view, whenever a business combination transaction happens, first and foremost thing you have to come is, or if it is a gain, you will call it as goodwill or capital reserve thing will compute only on the top acquisition. Subsequent computation or revaluation of goodwill is not permitted. Goodwill or capital is computed only once in lifetime, date of acquisition. So whatever number you get goodwill now, that will never change in your impairment of goodwill. Unless there is an impairment of goodwill, will never ever disturb the goodwill is computed on which date? Date of acquisition. So basic common sense tells us that PC paid, let us say example, 5 lakh rupees. Fair value of net assets acquired. I tell you that it is 4 lakh rupees. So for net assets that are visible, whose worth is 4 lakhs, I paid an amount of 5 lakhs. Means what, sir? I paid excess now. How much extra did I pay? 1 lakh. If 1 lakh I paid towards something which cannot be immediately identifiable as any asset. But I am not fool to pay extra 1 lakh if I don't anticipate any future economic benefit. I am paying extra means I prima facie believe that future benefits are going to come. Extra consideration, whatever you are paying, be identified as goodwill in your balance. So, how to compute goodwill? Compare purchase consideration with the fair value of net assets acquired on the date of. PC how to measure? Ind AS 103 will study deeply, and you understand that PC also has to be measured at fair value. PC also should be at fair value, net assets also should be at fair value. If both should be at fair value, when I compare them, the difference then will be correct number value of the prima facie thought process. This kind of comparison is correct when you acquire 100% of other companies' business. But in this example, if you observe, I did not buy 100%, I purchased only 80%. Even though I purchased 80% only, do I have 80% control or full control? Full control. 80% of ownership I am having, but decision making power only 80%. For the remaining 20% of the business, somebody else will come and take a decision. I am an owner to the extent of 80%, but I have control over 100% of the business of the subsidiary. Therefore, the standard says that even though you are a 80% owner, you should go with full consolidation approach. Full consolidation approach means every asset, every liability that is appearing in the balance sheet of subsidiary should be consolidated into the balance sheet of parent company. Even though you are coming to the goodwill computation. This kind of computation, whatever you are seeing here, is correct when you acquire 100% of it. You are not acquiring 100% of it. You are acquiring only 80% of the business. So, PC I paid for 80%. I am paying an amount of different example education. This you will compare it with fair value of assets on the date of our share. Means, suppose in the subsidiary company, the total net assets is 4 lakhs. 4 lakhs, so you are a owner only to the extent of 80%. 4 lakh into 80%. For a company whose net assets are 3,20,000, presenting your share, you paid a consideration of 5 lakh rupees. How much extra did you pay? 1 lakh 80,000. Here clarity is that means you purchased 80%, so compare only with net assets of 80% and then identify goodwill or capital reserve. In computation, whatever you are saying, I will just represent it in it. PC paid for 80%, let us take 5 lakh. Compare it with fair value of net assets on the date of as 5 and 4 comparing is wrong. Why? TC is paid only for 80%, whereas net assets I wrote 100% net assets. Cannot compare like that. What we will do is, we will add non-controlling interest. What is non-controlling interest? In that company, I am owner only to the extent of 80%. I am not owner to the extent of 20%. Some other people are there. To them also some share of net assets belong. So that I am identifying separately. Add non-controlling interest 20% on it of. Now, so how much should I add? There are two choices as per Ind AS 1. The first choice is to proportionate share of the date of acquisition. On the date of acquisition, total net assets of subsidiary was 4 lakhs. I am owner only to the extent of 80%. Remaining 20% belongs to somebody else. At 20% amount to identify separate. Now if you work out, now also you will get the same answer. This answer both are same, it's just a presentation difference. Earlier here I directly wrote 80%. Now what am I doing? I am writing 100% and writing 20% separately. As good as I am writing the same method. Am I clear till here, sir? This is how you compute goodwill. Now, Ind AS 103 gives a choice to us. Whatever you are seeing, this is one choice. There is another choice. What is that another choice? See, PC you will record at 5 lakhs only, as usual. There is no choice. Fair value of net assets, you don't have a choice. But NC, at 20% shares that are there in the subsidiary, you time being measured them based on the assets of subsidiary, how much you consolidated. You consolidated 4 lakhs. 4 lakhs to 20% is not yours. Still you are consolidating. So in that 20% which is not yours, you identify it as NC. That is one method. There is another method which is called as fair value method. Fair value method means at 20% shares are also listed in the market. At 20% shares, the market value bring them right there. Are not listed companies. There are so many methods of valuing share. Your entire AFM is that only. Apply some fair value method and bring the value of the share. That means the value of this 20% shares is not based on the assets independently worked. Okay, suppose let us say I put it as 95,000. Now, if I do this, I am having an amount of, that means, depending on the method what you choose, your goodwill number will definitely. That means, goodwill number is based on what now ultimately. TC and the fair value of net assets are given that they are anyway constant, they won't change irrespective of the method. So, depending on how much you measure it, measure the NCI, the valuation of goodwill also will change. So, between these two, which one I should follow? Both the choices. Both the choices are. Fair value method, examination perspective, you will use fair value NCI only if the question gives you fair value. You are not supposed to estimate fair value on your own, and what is also not right is 80% keep 5 lakhs you paid, 20% ke how much any calculation you should not do. That is wrong. That is wrong, sir. The question does not give you fair value, but you are in love with fair value method. That does not mean that you indirectly do 80% I paid 5 lakhs, so 20% what would have been the reverse calculation you should not do. Although in one or two questions I say that is wrong, sir. To learn from that question, rest all questions will go wrong. We can't work situation they did, but ideally that is wrong. Why that is wrong is 80% shares when I buy, I am getting controlling power also apart from ownership. So the seller will charge a premium, and as a buyer I don't mind paying that premium because he is not selling me just to ownership. He is giving me entire entity ka decision making power. Won't he charge a premium? But if I am buying only 20% shares, I am not getting any decision making power, so I won't pay any premium in that. So 80% whatever you paid, correspondingly 20% proportionate amount you will pay is a wrong thought. 99% of the questions it won't be like that. Here and there if ICI has done something, they have done one. I can't help, but ideally that is wrong. Okay, so till here clarity is there, two methods are available. Both the methods are okay. Now, the first method if you apply, the resulting goodwill whatever you are seeing, it is referred as partial goodwill. Whereas in the second method, it is referred as goodwill. What is the meaning of this? When you say partial goodwill, what it means? It is the goodwill of entire subsidiary company to the extent it relates to our share. Because you consider only your share of shares ka PC, you effectively consider only your share of 80% net assets. So goodwill also will be representing only 80% of the total goodwill. This is partial goodwill. Whereas when you compare 100% fair value, see 80% fair value, 20% fair value. So this is 100% shares ka fair value versus 100% net assets ka fair value. In that case, goodwill also will be this full goodwill of, in this 2 lakhs, NCA's share of goodwill is also included. Whereas here the goodwill entirely relates only to parent company. Now why this partial goodwill, full goodwill concept is important? Later on, when we do impairment of goodwill, a loss who has to bear depends on whether the goodwill is a partial goodwill or full goodwill. If for example, you have an impairment loss in goodwill, you understand goodwill is an asset. If I tell you that there is an impairment loss, that means what? Your asset goodwill has to be reduced. Asset reducing is a loss. The loss who has to bear? The answer for that is loss is to be borne by that parties who own goodwill. If it is partial goodwill case, the goodwill belongs to whom? Only parent. Actually subsidiary's goodwill only to the extent of parent's share it appears in the consolidated balance sheet. Any loss in this goodwill should be borne only by the parent company. Reserves and surplus, so we will adjust it up, consolidated reserve. Whereas if any impairment loss arises in this, that impairment loss should be adjusted towards parent also, NCA also, because it is full goodwill of the subsidiary. Subsidiary who are the owners? Parent also, NCA also. So loss has to be borne by parent also, NCA also. Impairment of goodwill की key point is related. Clear? After we understood goodwill, rest of the procedure is very easy. Consolidation as given under Ind AS 110 is line by line addition of assets and liabilities. Take parent balance sheet, take subsidiary balance sheet, one by one, all assets, all liabilities add. And in the process some adjustments are there. Adjustments how to do and all we will see in the process. Okay. So broadly this is one more point. Even though consolidation we normally do it in the form of some steps, some 5 steps, 4 steps, people do 8 steps, different models of it. Even though consolidation probability that is sufficient, there are few questions where consolidation you have to do by writing journal entries. Consolidation key steps, date of acquisition, date of consolidation, post acquisition, pre, this will not be sufficient. You have to take entries for consolidation. There are questions like, okay, so that also you have to parallelly prepare. So one is SFS, one is consolidated. Parent company, what it does is, suppose there is a business combination transaction resulting into parent subsidiary. It has to divide its book into 2 categories. One is its own financial statement, called as separate financial statements. A separate books of accounts have to be opened now for consolidated financial statements. At the starting point, e-books and e-books ka base is same. That means whatever assets, liabilities and equity that is there in SFS, asset, liability, equity also will same amount to CFS also. Now what happened? You went and purchased 80% shares in subsidiary. When you buy investment in subsidiary, what is the entry you write? Investment in shares account debit to bank. Correct? No? The entry, if you are writing, what is happening? Your bank balance is reducing, and in your asset side, one investment in shares of subsidiary, one account will come. The balance sheet only is called as separate financial statement. The entry you are writing SFS books. Correspondingly, you also have to maintain separate books of accounts for CF. Consolidated books. Not mandatory, but many companies do maintain it. But transaction one way, but accounting will happen in 2 books. One is in SFS accounting, the other one is CFS accounting. In CFS accounting, you will not recognize investment at all. You will directly recognize assets and liabilities, goodwill or capitalism of NCA. Directly you will record. How, sir? The particular method is there, goodwill computation sheet is there. In the whatever numbers you are seeing, convert that into journal entry. That's it. Tell me, sir, how much PC did you pay? Yeah. To bank, I will record 5. What is the fair value of net assets you purchased? 4 lakhs. Right, 4 lakhs. Did you recognize NCA also? Right. What is NCA value? 80 or 1 lakh, depending on which method you select. Let us say I am writing 1. When I write net assets, I mean to say you should write assets also, liabilities also separately. Just for understanding, I wrote net assets. Now, the entry pakka will not tally. Gap are you getting? Identified as. What did I tell you? Before you write this entry, asset liability of parent company. Here also asset liability of parent company are there. All assets, liabilities, opening balance, everything is there. On that, when you overlap this entry, what will happen? Cash balance will reduce, investment account gets created. When you overlap this entry, this book will happen. The PFS, your SFS, it was there here, that gets converted into consolidated. Because already your assets of parent is already there. Parent assets, liabilities, equity is there. To that, your assets of subsidiary, liabilities of subsidiary, goodwill, cash outflow. What will happen, sir? Your SFS will be transformed into PFS. A stepwise accounting, whatever we do, that's how we will present it. But background accounting also important, sir. There are some questions you will not be able to touch if not for this background. Am I clear here? This and drama is happening on which date? On the date of consolidation. Always does not mean that I will do some 4 or 5 steps and consolidated balance sheet. It's not like that. The background is very important. Clear now? Last point before we hit questions, understand steps. For example, this is the date of acquisition. As on today, parent separate books is there, subsidiary separate books is there. So they have one balance sheet. You also have one balance sheet. And on the date of acquisition only, you can also prepare a consolidated balance sheet. Up to here we learned how to do consolidated balance sheet. Write this entry. Entry, if you write, SFS of parent will get transformed into. Understand, sir? You should not get doubts like, why are you creating 2 times bank account and all? Arey Babu, this is in different books. In different books. 2 times, why are you creating? Don't even think, go into that. It's separate books of accounts. That is another books of accounts. Key books of accounts are reduced files. There are the reduced, no. So, like that here. Now come here. This is the date of acquisition. After acquisition date, 1 year passed. There are no standing after 1 year. In this 1 year, his subsidiary net assets, when you saw for the first time, it was 4 lakhs. But in this next 1 year, subsidiary net assets improved to 4 lakh 50. Tell me, sir, why will subsidiary net assets change? Why will net assets change? They bought new assets. If they buy new assets, no, net assets will not change. Why? Bank will reduce, asset will increase. That is not the reason for increasing net assets. What will be the reason? The next 1 year, is subsidiary company profits are earned by. A profit can be their business profit. They sold some assets, they made profit. They got a capital reserve, some other, doesn't matter, it is a profit. Profit who earned? Subsidiary. And when subsidiary earns profit, subsidiary net assets will. Last year, that means on the date of acquisition, how much net assets was there? 4 lakhs. At that time I already consolidated, but in the next 1 year, net assets of 4 lakhs now became how much? 4 lakh 50,000. I extra 50,000 also I should consolidate or not? But you must also understand that extra 50,000 is because of something called as post acquisition profit. Correct? The profit subsidiary has earned after I obtained control on the subsidiary. So it is as good as if profit is mine only. Right. So E profit how much is yours? 80%, our share. That you will add it to your reserves. Whatever 20% is that belongs to whom? NCA, that you will give it up to. Understand, the post-acquisition profit does not belong to us completely. It is earned under our control. But whatever is your share, you take it to your reserve. Whatever belongs to NCA, that you will give it to us. So here. Now, sir, but subsidiary books already some reserves are there here on the date of acquisition. In that reserves also we will have a share, no? Correct. We will definitely have a share in everything of subsidiary. There is no doubt in that. But tell me, sir, reserves, profits which are already there in the company by the time you entered, that profits you earned, you purchased. You purchased it. Somebody else earned it. Somebody else made decision. Somebody earned profit. Profit is still undistributed. It is there in their balance sheet. But today I ask the old owner to get out and I am sitting in this place. The old owner will take money from me for the profits that are there in the business also. Means what? Those profits are also profits, but they are purchased profits. They are also called as pre-acquisition profits. Whatever profits we earned after the date of acquisition, they are called as post-acquisition. This is the basic background. Based on this, we will do one or two small questions just to understand the flow of this entire thing, how we are going to present it. Once you understand the flow, I will take you through adjustments. But don't worry, there are hardly some 5 or 6 adjustments. 5-6 adjustments you are through, any time you can is that sense. Then to make a flow, you should understand. Next, order of adjustments is also important. Just because you like, that doesn't mean that you will go and do revaluation adjustment first. Wrong answers. This is the order. Dividend adjustment, time adjustment. There are different adjustments. Orderly, if you do only, answer will be correct. And everything there is a reason also why you should do in a particular. So let's pick up some 1 or 2 small base questions. This everybody will be having in your books when you practiced for previously, but I will show you 1 or 2 questions, small ones. First, I want you to look at this example. A very small question, but it will help you understand the entire flow of consolidation. See, the objective here is to understand the logic, sir. That's important. Please pay attention. There are 2 balance sheets given to you on 31st March 9. Parent company, subsidiary company. TP is given. Investment in 70% shares of estimated 10,000 rupees. Brackets they gave you. Date of acquisition is on 1/4/18. Today you are standing on which date? 31st March 19. So acquisition happened 1 year back. Current assets are there. Share capital is there. Retained earnings, both the companies ko opening balance. At the beginning of the year, how much was there? Current year, how much they earned, both are given. Current liabilities are given. Prepare consolidated balance sheet on 31st March 19, assuming that NCA is measured on PSNA basis. So they want to measure NCA on PSNA, not on fair value basis. So the resulting goodwill will be full or partial? Partial. Now, what you have to do? 4 steps you have to understand. First one, you have to prepare statement of net asset in. But there are many ways of presenting a consolidation solution. I have seen many methods. I also know many methods of presenting. Considering everything, trust me, is the most easy way. You can't find a much more easier unless you are already used to something. Then you find that is easier. But trust me, sir, I know all the methods. This is the most easy. You will have 3 amount columns, sir. Date of acquisition, changes column, date of consolidation. In this sum, acquisition date is 1/4. Changes is 12 months period. Date of consolidation is today. That is particular column is anywhere. In this, we should start with share capital of subsidiary. You see, what is the share capital of subsidiary given? 5,000 rupees. When no information is given, you have to believe that on the date of acquisition also, share capital amount is. Therefore, post acquisition, there is no change in the share capital. Coming to reserves and surplus. They have only one item, which is their retained earnings. This retained earnings balance closing is given as 3,500. Here beginning also they gave you as closing is 3,500. Here beginning it was 2. That means what is the change? You all agree that this 1,500 rupees balance in figure whatever I got. The post acquisition profit of 12 months. column 7,000, second column, last column generally irrelevant. So this is the net asset. There are no adjustments. This being the very first question. So the first column basically gives you net assets on the date of acquisition. Second column gives you changes in net assets after the date of acquisition. Directly nothing but post acquisition profit. Share of limited. 1500 our share is 80%, which is 1200. What belongs to NCA is other 20%. This is how we propose our. Now, step number 1 is the last column is generally irrelevant unless we need any specific working note. In all our experience, there is only one question where last column computation is irrelevant. Otherwise, generally on the consolidation date net asset is not, but because anyway we are going to prepare balance sheet. Step number 1 is this. Step number 2, you will go and work out goodwill or capital. How to work out goodwill or capital reserve is the same template what we used earlier. PC. For 80%, how much PC are we offering? Go and see the balance sheet. In the investment cost you have to take 10,000 rupees. So that 10,000. That idea. Oops. This is PC for 70% I paid 10,000. NCA 30% on date of. Question tells you that you have to apply SNA. You have to minus the fair value of identifiable asset on the date of. If I want net assets, should not go and total all the assets minus all the liabilities. Rather, what is easy? Air capital plus reserves and surplus if you total, that also will give you net asset. That already we did. First column. Is 7,000 rupees. Bring it on. In this, 30% is NC. 1,001. So 5,100 positive number I am having, and this is good. It's the same template what we discussed, nothing new. Okay, next. Step number 3. NCA for consolidated balance sheet. In the consolidated balance sheet, NCA, how much will you show? For already we measured NCA. You already measured NCA, but on which date? Acquisition date. But today you are standing 1 year after acquisition date. In this 1 year, whatever profit subsidiary has earned, in that some profits also belong to NCA. So for that one more NCA you have to complete, but this is for balance sheet preparation. NCA on the date of acquisition, 1,100. To that add their share of post acquisition profits. This is 450. Already we computed here step number 1. The number will go into step 2. The number will go into first computation is important. So from here only all the flow will happen. Step 3. So this if you total it up, 2,550 total amount of pay for consolidated balance sheet. 1 is net asset, step 2 goodwill capitalism, step 3 NCA for C. Step number 4 is other equity for C. How to measure other equity? Parent company reserves you have to take from the balance sheet. Parent company, how much reserves are there? 15,000 balance sheet. Take that. Reserves and surplus. To this 18,000, add parent's share of post acquisition profits 10 other equity which will go for C. Other equity for consolidated. Step 1 is net asset, step 2 goodwill capitalization, step 3 is NCA, step number 4 is other equity. See sir, in this question I have only one profit which is retained earnings. If they were having retained earnings, general reserve, securities free, other reserves like that, in that case I would have maintained multiple columns. One for general reserve, one for retained earnings like that. Only one is this, so one single column I adjusted everything. Then though you maintain multiple columns, ultimately you have to again total them into a single number only. So just because you write multiple columns, main balance sheet you will not write individual numbers. Combine they club it and call it as other equity. But the reason for writing separate columns is one is presentation. Second one is when they prepare consolidated financial statement, when they ask you to prepare CFS, this step number 4 only will become your statement of changes in equity. Consolidated. You prepare columnar, that itself will be a statement of changes in other equity. Again, you need not do any working note. That's the point. Coming to the final consolidated balance sheet. Consolidated balance sheet as discussed, nothing but line by line addition. Line by line addition means each and every item go on adding them. So what is PP amount? 15,000, 8,000. It should be. The investment that is there in parent company books, our investment should not be written in consolidated financial. Because our investment is in share capital of subsidiary. Investment in share capital of subsidiary is indirectly investment in net assets of subsidiary. When those assets and liabilities itself are copied into your books, the investment again should not be coming into the consolidated. Ignore the investment. Current assets 5,000. Share capital. Always we should write share capital only of the parent company. Parent company ka share capital is how much? 10,000. Other equity, whatever we just know. Non-controlling interest for CDS. Step number 3, 2,550. Current liabilities 2,000 plus 1,500. So this is preliminary version of consolidated balance sheet. In this, apart from preparing step 1, 2, 3, 4, after doing 2 or 3 questions or steps and all, happily you will get used, not a problem. Balance sheet, what are the new points you remember? Observe. Investment in subsidiary should not appear in the consolidated financial statement. You should write only share capital of parent company. Then you should not forget to take goodwill or capital reserve as the case may be. But till here you understood what is happening. My idea is, don't write this. This is correct only. I am showing one full version so that you will have more clarity. It will definitely help you, sir. Watch carefully. PP, my PP is 15,000, parent company. That fellow's PP is, in my balance sheet, I have investment in shares of hostage. We are having also current assets. Given minus 5,000, other fellows component. Coming to share capital. Parent company का share capital 10,000. Subsidiary company का share capital is 5,000. Or we should not add subsidiary company का array, sir, it will not come. But I'm adding. Retained earnings. My retained earnings is 18,000. That fellow's retained earnings is 1,000. Coming to current liability. We technically already finished our consolidated balance sheet. What is this balance sheet? Parent का standalone, subsidiary का individual balance sheet, both I literally merged. Asset, liability, share cap, everything I merged. Now, E balance sheet, time value addition is this one. But instead of this number, you are seeing these numbers. Because in line value addition, if you do have investment also, you will have share capital of subsidiary also. Where are all they? Why are they not appearing? What happened to them? In step 1, 2, 3, 4, what did you do with the remaining numbers? All that we will get. Step number 2, just see what you have written. Okay. Fair value of net assets. Is 7,000, how did we get? 5,000 plus 1,000. What is 5? Share capital. 2,000 is pre-acquisition profits. So watch this. Is 3,500 also. 2,000 is pre-acquisition profit. 1,500 is. In the Goodwill template, basically what is happening is we are cancelling the investment with subsidiary का share capital, subsidiary का pre-acquisition profits, and parallelly recognizing one new item also called as, and NCA recognized at what amount? 2,000. And also immediately recognizing an amount called as, as step number 2 what we did, that TC and whatever you wrote are the investment. Fair value of net assets on the date of acquisition, whatever you are writing, that is share capital plus pre-acquisition profit. There 3 items died. These 3 died and got result into 2 new numbers. One is NCA, one is another way life I should tell. Look at this. Here I am removing how much? Here I removed 5 plus 2. Right? I removed how much? 7,000. So, right side, asset side, I removed how much extra? 3,000 I extra removed. Correct? No? I have to put it back. Otherwise, balance sheet will not tally. So, 3,000 extra is there. But now I recognize the 2,100 also extra. Because of that, the gap is now not 3,000, 5,001. 5,100 again, put it back with the name of, otherwise balance sheet. Are you understand? I'm killing something and I'm ensuring the balance sheet tallies. And then the procedural explanation is there. Why it is goodwill, how to value, all that is there. Okay. Coming to the 1,500 profit. Since it is post-acquisition profit, in this 80% belongs to us. 20% belongs to NC. This 80% is how much? Sorry, 70% belongs to, sorry, 1050. 1050 belongs to parent. And 450 belongs to, so 2,100 plus 450 come 2,550. Correct? Whereas 1050 came to your reserves already is there how much? 18,000. Plus this 1050. Total it will now become 19. Rest of the item simply add. In consolidation process, if somebody asks you, sir, what happened to investment in subsidiary account? What happened to that account? Account died. What happened to share capital of subsidiary? Died. What happened to pre-acquisition profits? Died. Sir, when sir? Step number 2 no they died. At the same time, you created 2 new accounts. What are they? NCA and NCA, you have a choice. What are the choices? SMA or fair value. E particular sum we adopted which method? PSNA. If the question tells you that NCA is not PSNA, NCA is a fair value and fair value of NCA is 2500. So here will be 2500, goodwill will become 10,000. Are you understand, sir? Based on NCA, goodwill number will change. Are you having full clarity now procedurally? Now how to achieve this? You need not do all the stupid cancellations and all. You will smartly do like this. Step 2, step 3, step 4. Ultimately, balance sheet neatly will be looking like this only. You will not write investment, kill it and all. No. You should present like this. But you should know what is happening to which. Again tell me, sir. What happened to pre-acquisition profits of subsidiary? Cancelled. Which step? Pre-acquisition profits subsidiary cancelled. Share capital of subsidiary cancelled. Investment also cancelled, resulting into NCA and goodwill. Remaining numbers I don't have a problem. Let me merge and so issues will slowly come. You will say there is unrealized profit in somewhere. You will say intercompany debtors is there. There is some revaluation required. Issues will come. These are very easy. You just understand this core structure. Rest of the game is very simple. Clear till here? Now I want you to observe something else. Net assets in subsidiary on date of acquisition is 10,000. First step का first come. Therefore, NC on the date of acquisition at PSNA basis 1,100. But NC on the date of consolidation is 2,100 also, plus their share of post acquisition profits also, which is 450. Overall it is 2,550. Here till now, what I want you to observe is, how did you get an acquisition date? You took the net assets in subsidiary, that 7,000 rupees net assets in the subsidiary into 20% duty on date of this you got this. Now, what's this balance sheet? Count the net assets in subsidiary now. 8,000 plus 2,000. Let's say it is how much? 10,000. Liability side, the one liability is there. 10,000 minus 1,500. How much is that? 8,500. 8,500 net assets into if NCA on acquisition date is measured at PSNA, then NCA and consolidation date also will be naturally at PSNA only. Subsidiary ka net assets, how much you are consolidating, 13 to 30% if you apply directly NCA on consolidated balance sheet in your balance sheet. When doing these steps, no, we did not perform like that. We did like this. But E number 2550, I can also verify. Instead of doing like this, what I could have done, take subsidiary ka balance sheet, assets minus liabilities to 30%, then also will get the same. You should know this. Reason, there are some questions where NCA is missing. They will not tell you NCA. NCA now also we only got E could not this type of question. Call theory question. Where you want NCA number, question won't give you NCA number, but you have net assets on the date of consolidation today. Today's net assets of subsidiary is there. Into 30% you apply NCA appearing in the consolidated balance sheet. So this is a small shortcut. But E method is applicable only when it is measured at PSN. Fair value method will not work. Clear? So, this is the entire setup of base consolidation. Now in these issues, one issue we already discussed. What is that? Goodwill. If there is a impairment of goodwill, how will you account impairment of goodwill? Impairment of goodwill is a loss. The loss will be borne by either parent alone or parent with NCA, depending on whether goodwill is a full goodwill or partial goodwill. This full goodwill loss will be taken up by parent ka reserves and surplus also, NCA also. If it is partial goodwill, entire impairment loss should be borne by parent ka reserves and surplus. This is one point. These steps, whatever we discussed, all these steps and all I have given here. In the where the flow will happen. See, these steps are just for your understanding purpose, sir. You can modify the steps, you can create one more step if you want, all that you can do. The basic steps. In this, one by one issues, sir. First, we will talk about revaluation of assets. Sir, I will give you the example. You will tell me while doing step 1, step 2, step 3, step 4, where this adjustment has to be impacted. You just understand the numbers right now. This is date of acquisition, 1480. This is balance sheet of subsidiary. In their balance sheet, there is a plant and machinery. It is having the book value of 100. On this 100, so this fellow is parent. When they want to invest in subsidiary, won't they go and value how much is the worth of their assets and liabilities, and definitely value no? So in my eyes, the plant worth is 100. Worth of the plant and machinery, fair value of the plant and machinery according to parent company on the date of acquisition is 120. Fair value is 120. Why is subsidiary showing at 100 only? So their policy is to follow at cost model. Let them follow at cost. But business combination purpose, you have to record all the assets and liabilities at what value? Fair value on the date of acquisition. If your assets and liabilities are not recorded at fair value, goodwill number will be wrong number. Therefore, you compulsorily have to fair value. Who? Parent company. But subsidiary company point of view, in their own standalone books, they are showing it 100 rupees. Okay. Now, during this 1 year, subsidiary provides rupees 10 depreciation. Imagine 10 years life for 10%. As a result of this, balance sheet of subsidiary on this date, observe consolidation date, asset is appearing at 19 on 31st. The 31st March 19 is your consolidation date. On this date, you are preparing consolidation. As usual, we do line by line addition. Because of line by line addition, subsidiary assets will be coming into the parent company consolidated balance sheet. So, this plant, whatever is there, plant will come here. Naturally, at what amount? But group point of view, the number is wrong number. Why group point of view, this number is wrong number? From parent point of view, what is the worth of this asset on the date of acquisition itself? 120. On this, if we provide 10% depreciation, how much depreciation they should have provided? 120 to 10% is 12. 120 minus 12, the asset ultimately in the consolidated balance sheet, group point of view, appearing at, how did I get? 120, which is fair value on the date of acquisition, minus depreciation for the post acquisition. But what naturally comes is not 108, 90. In 90, how will I make it 108? First and foremost. On the acquisition date, you observe that there is a revaluation profit. How much revaluation profit is there? At 20 recognized. So this side add 20. Balance sheet will not tally. Consolidated balance sheet will not tally. If you add only on the right side, left side also you have to add. Add 20 here. Revaluation. Simple question. The revaluation profit is pre-acquisition or post-acquisition? Pre or post? Pre. Because the profit was already there by the time I went there. They did not recognize, they recognize it. That's all. But profit is already there. Asset value already increased by the time I went there. The pre-acquisition profit. Now, I had to recognize initially only at 120. Depreciation for the current year should have been 12. Subsidiary anyway provided depreciation of 10. The excess depreciation, further depreciation they have to provide now is minus 2. That side if you minus, here also have to minus. Additional. The additional depreciation, since it is for post-acquisition period, this has to be adjusted from the post-acquisition. See now, on the right side, asset side, 90 came, 20 you added, 2 you minus, ultimately your desired number of 108 is there. How are you ensuring that balance sheet tallies? Correspondingly, at 20 and 2, you adjusted to your reserves also. 20 went into pre-acquisition profits, minus 2 went into your post-acquisition profit. Consolidated balance sheet, definitely 100%. Are you understanding, sir? What is the adjustment you are doing? That is one thing. How balance sheet will tally despite doing all the adjustments? This is the reason. While doing your steps, step number 1, of 3 columns, date of acquisition, post acquisition profits column, consolidation. Here anyway you will write share capital, other equity on the date of consolidation. This is post acquisition profit. Whatever you get here is actually book value of net assets. This is post acquisition profit. But goodwill computation, I don't want book value, I want fair value. So we already know that 20 rupees you have to account, minus 2 you have to account. For 20 and minus 2, where you have to account? 20 is a pre-acquisition profit. Revaluation. Pre-acquisition means on the date of acquisition. Additional depreciation is post-acquisition. So since you adjusted on the profit side, again asset cost you have to add, plant and machinery cost you have to add, that where will you do? Final balance sheet you have. So when there is an upward revaluation of a depreciable asset anyway both the adjustments will happen, revaluation profit also, additional depreciation also. But revaluation profit on the profit side, it is a pre-acquisition item, additional depreciation is a post-acquisition. Now this is book value of net assets. So that when you add revaluation profit, what will happen? From fair value of net assets. That fair value of net assets is what you will use in goodwill calculation. Then correct goodwill will come. The whole idea. Here, next. Now that I told you depreciable asset, non-depreciable asset I need not discuss. If it is land, what will be the case? Same case. Only thing is depreciation part will not be there. What if it is a revaluation loss? Everything is same. Wherever minus are there, that will become plus. Pluses will become minus. Revaluation profit, I am adding, revaluation loss, I will minus. Here I am having additional depreciation. There depreciation, the reversal will be there. Place of adjustment will change, will not be there. Amount ka signs will change. Plus will become minus, minus become plus. The revaluation loss case. But I wanted to do one more adjustment. Similar one, but different. Subsidiary balance sheet, there is stock. Stock is appearing at 100. These costs are inherent, whichever is lower from subsidiary's point of view. Ind AS 2 they would have applied. On the date of acquisition, parent company point of view, this stock has a fair value of 120. Therefore, parent identifies a revaluation profit of inventory. Why will the fair value? Sir, Ind AS 2 does not permit. Who cares about Ind AS 2 now? Is Ind AS 103. Entire goodwill computation is as per Ind AS 103, and that follow says every asset, every liability should be measured at fair value. Fair value. And inventory, it doesn't matter. You will think that when I say revaluation profit here, I am applying Ind AS 16. No. Yes. We are not talking about revaluation model. We are talking about revaluation of assets and liabilities on the date of acquisition in a business combination transaction. Perfect. 1 year is over. Date of consolidation. In the balance sheet of subsidiary, after 1 year, hypothetically imagine that the stock is still unsold. Now I am to prepare consolidated balance sheet. Line by line addition I will do. The process what will happen is stock will come here only at, but in my eyes your worth is not 100, is 120. I want 120. Tell me what should I do? If you do simple, make it 120. Balance sheet will not tally. This side also you have to add. Where will you add? Pre or post up? Pre or post? The inventory was already there on the date of acquisition only. By then only its value was 120. The inventory value did not increase because I entered. No, it already was on a higher side. Okay? Acquisition. Now tell me, sir, while doing step 1, step 2, step 3, step 4, where will you adjust this? The 20 rupees as usual we add it to date of acquisition column in step number 1. First column we will add. First column if you are adding means you are adding it to pre-acquisition profits only, when pre-acquisition profit. So that you will add. Balance sheet again you have to add. Clear? Slightly change the question. Is stock, sir, whatever you saw, whatever you highly valued in your mind, a stock is not there now. Why? Sold. Question is, the one you saw, the one you valued highly in your heart is no more there. Somebody else took it. So, today still do the adjustment. If your stock in my eyes, its worth was 120. Revaluation profit, I identified 20. But consolidation date ka stock is not there. Do I need to do any adjustment? Not required. Sure? Need to do or we should not do? Half you will do. There is only one answer. You will or you will not. Have to. No option. No option. If you do not do, what will happen? Think. Step number 1. When you write share capital plus other equity on the date of acquisition from the balance sheet of subsidiary, the number will be book value of net assets. I don't want book value. I want fair value. Fair value will come only when you add revaluation profit. Otherwise, it will not come. I don't have a choice, sir. I don't have a choice. If you take book value of net assets for goodwill computation, goodwill is correct number. Goodwill also will be wrong number. Getting it? Compulsorily you have to revalue. There is no option. So then how to do it? That we will see. That's a different story. First, realize that you have to consider date of acquisition, date of consolidation, in between changes column. Then share capital will write something. Other equity I will write something. Here I will get some balancing here. The basic structure from the balance sheet, you can prepare this one. Now what I am trying to say is add revaluation profit on stock. Definitely you will add this side. If you do not add, your goodwill will go for a toss after you have add. For left side you are adding, but right side I don't have anybody to add. How will the balance sheet tally? How it will tally is right side you will not add, you will again remove it from left side only. But you have to move this from revaluation profit on stock is sold in post acquisition. You have to remove it from the post acquisition. Why should I remove it? The stock of book value was how much? Once upon a time 100. But by the consolidation date it is there as sold off. Sold off. Imagine now. Subsidiary sold the stock for 100. Subsidiary's point of view, what is the carrying amount of the stock? They sold it for 130. Profit is how much? 30. Subsidiary point of view, post acquisition profit is how much? 30. But parent point of view, is stock worth in my eyes already 120, which our group as a whole, if you see, stock worth 120 subsequent to my acquisition has been sold for 130. 120 ka stock we sold it for 130. Profit is how much? Group point of view, post acquisition profit is only 10. A subsidiary standalone point of view profit is 30. 30 subsidiary's point of view profit is there? No. That is included here. But the group point of view profit is only 10. I want only 10 here. Who will get only 10? So even though stock is not existing on the consolidation date, still have to consider revaluation profit of that. And since the stock does not exist, you can't add it to the stock, so balance sheet will not tally. So some other adjustment has to be done. What is the adjustment? Remove it from the post-acquisition profits. If you remove it from the post-acquisition profits, correct post-acquisition profit will come. If you don't do this adjustment, what will happen? At 20 rupees profit, which subsidiary earned, means total earned 30, I entire 30 naturally will be there in the post-acquisition profit. But at 30 to 20, from group point of view, is not post-acquisition, that is pre-acquisition. and that I am already recognizing here. Here you have to minus. Then this number will be correct number. You understand what is happening, sir? See, to consolidation, always our thought process should be draw one dummy balance sheet. In case any time you get confused, draw one simple balance sheet. Acquisition date, what was the balance sheet? Only with one item. Consolidation date, what is there? Group point of a consolidated balance sheet, what will be there? What do I want? How to achieve what I want? E thought process, E framework, if you think, sir, there can't be easy chapter than consolidation. Hardly there are 6 adjustments. The 2 are already over now. Impairment is over. Valuation. Are you understand what I am trying to say? Tell me, sir, why we have to do fair valuation of PPE, fair valuation of stock, fair value? Why should we do that? Goodwill, if it has to be correct, number should be at fair value. All this I have written here, sir. Gain also, what will you do? Loss, what will you do? Additional depreciation, how to compute? By the way, this is also one point. Look at this. First case again, 100 book value, revaluation profit 20. A revaluation profit is obviously pre-acquisition item. Additional depreciation 2. E2, how did we get? E2, how did we get? Sir, how did we get 2? How I explained it when discussing this example is, group point of view, asset ka fair value is 120. So for the post-acquisition period, depreciation should be 120 into 10%, it's 12. Subsidiary already charged 10. So I have to further provide 2 while preparing consolidated financials. Correct? No? Just like that I am writing. Additional depreciation, P-value, to take the fair value of depreciation for period post indirectly. First box is represented depreciation whose point of the entire group point of minus depreciation already charged by. This is a formula for the 2 rupees. In this correct sum, this is a current sum, 120 into 10% minus what they charged is 100 into. So I want 12, since you already provided 10, I have to further provide the formula. There is another shortcut method. Smart. The shortcut method. Additional depreciation is. Take revaluation profit. What is revaluation profit? This is much more faster, much more easier. 2 methods. You can do any which method, answer will be same. Okay? Sir, even anyway answer will be same. Why to discuss first method at all? Second method is looking very quick, fast, easy. Reason for discussing both the methods. Second method will give you wrong answer in one. Second method will ruin your entire sum. You don't even know what hit you. Balance sheets will tally, marks will not tally. Second method will land you in trouble, sir. In one case. Sir, then why to discuss second method? We should have always stick to first method. Reason, there are questions where the question won't tell you fair value of the asset. It will tell you, on comparing the fair value with the carrying amount of PPE of subsidiary on the acquisition date, we identified a fair value gain of 50,000. Directly revaluation profit they are giving. In that case, revaluation profit, how to compute depreciation you should know. But you should also know which case you should not apply. Which case? Do not use shortcut method. Acquisition takes place during the year. Whenever acquisition of shares in subsidiary happens at the beginning of the year, no problem. Any method you use, no problem. When acquisition happens during the year, second method and first will not give you same answer. Two different answers. Second method is wrong answer. Keep one important answer. Tested also twice till should know both, but why it will fail is it's a simple maths. Maths lo problem will come. Get this. I am assuming middle of the year as data acquisition. Here beginning carrying amount is 100. For the entire year, subsidiary provided 10 rupees depreciation. This is consolidation. This is date of acquisition. Then consolidation date, carrying amount of the asset is appearing at on this date. We fair valued the asset to 120. Tell me, sir, what is the revaluation profit? If you mess up here, there is no point in discussing further. Just like that, asking what is revaluation profit? What is the total depreciation? 10 for the year. So for the first half, because acquisition is not at the beginning of the year, acquisition is in the middle of the year, exact middle of the year. So here subsidiary would have provided 5. Carrying amount would have been 95 book value asset. I am remeasuring at 120. Therefore, revaluation profit is equal to additional depreciation. First method, if I apply, how I should think? Take the fair value of the asset. What is fair value of the asset? On the data proposition. 10% for post acquisition period depreciation. How much I want? Yes. How much subsidiary already provided? Subsidiary already provided how much depreciations are during this period? Totally year they provided 10. First half to 5, second half to 5. What I want is 6. What they provided is 5. So additional depreciation is the answer, sir. Again, if you apply shortcut method, revaluation profit is 20 into percent into the answer is wrong. Where is answer is wrong answer? Consolidated balance sheet point of view. When I do line by line addition, subsidiary books flow plant whatever is appearing at 90, it will come into my books also at 90. So this definitely I will add valuation profit of 20. Now I have to remove additional depreciation. After removing the number should be how much that I already know. What is the fair value of the asset on the date of acquisition? 120. Yes, 120 with 10% depreciation for 6 months I have to provide. 120 minus, I want the answer to 90 plus 25 is already 115. Final answer should be 114. One answer will come only when you apply the graph. Start the support, sir. You understand this is a very fine point. Tested already, it's not something for the sake of fun we are creating it. Already tested. Twice or thrice this question. Big question it will come. Don't do shortcut if acquisition takes this. It happens at the beginning of the year, any method is okay. The impairment also covered. Elimination of contra items within the group. This is nothing but intercompany receivables and payables. Now watch this. I'm directly showing on the consolidation date. The P Limited balance sheet, parent, the S Limited balance sheet. In P Limited balance sheet, it has a money receivable from S Limited, 1000. So S Limited books, this is appearing as creditor payable to P Limited. When you prepare consolidated balance sheet, you do line by line addition. So this debtor, creditor also will enter into the consolidation balance sheet. But it is a receivable or payable within the group. Consolidated balance sheet is prepared from entire group point of view, treating parent and subsidiary together as a single entity. When we both put together as a single entity, can I receive from myself? Do I owe money to myself? No. So, in consolidated balance sheet, to do consolidation, credit in debtor and this creditor, whatever naturally will come like this, that you have to eliminate. You will not write and cancel it, you will minus it. From the total creditors you minus 1000, from the total debtors you minus 1000. So naturally 1000 will get cancelled, remaining balance sheet will tally as it is. Yes sir, this is one adjustment. In this second version, parent is telling that subsidiary owes me 1000, but subsidiary's balance sheet amount is showing as 700 only. There is a gap. Now why there is a gap? Subsidiary sent a check or subsidiary sent a cash, but that money is not yet received by the parent. This is the case of check or cash in transit. Now in this case what will happen is, balance sheet position is like this. What you will do, wherever intercompany item is there, with whatever amount it is, I amount to remove. Debtor how much is there? 1000, remove 1000. Creditor how much is there? 700, remove 700. What is happening? Asset side you are removing 1000, liability side you are removing only 700. So asset side you extra removed how much? 300. At 300 put it back, otherwise balance sheet will not tally. And describe it as cash or check in transit as the case. What you should remember is, total creditors, the parent creditors plus subsidiary creditors put together, in that intercompany payable is how much? 700 minus that. Total debtors, parent debtors, subsidiary debtors, in this total amount, how much is intercompany receivable? 1000, remove that. By doing that, what is happening? One place you remove 1000, left side you remove only 700, so extra 300 whatever you removed, that is still going to come in the form of cash. Go and display it as cash or check in. Here's the next one, another case. Very rare that this question will come, chance is very less. But I will always explain this since very beginning. One fine day, ICA ask us this. All adjustment. Not there in your ICA study material. Theory also not explained. The old AS based question. There that fellow copied. It is not 100% relevant now. Some came from this question. What is this case is? Subsidiary issued debentures. The parent fellow he purchased the debentures also. Okay, so debenture is nothing but a loan, no? So it is loan given, loan taken kind of thing. So this is also a intercompany owing. So when we prepare consolidated balance sheet, naturally what will happen? Debentures will come originally at 500. Investment also will come at, tell me sir, how much I should cancel from debentures? Investment cost 120. Investment cost 120. But debenture investment face value is only 100. Subsidiary how much liability will go away? In group point of view, how much face value of liability is not there? 100. Here you can cancel only. Here also you can cancel only 100. Means 20 extra is there. Here entire 120 removed, but in this I can remove only for 20 whatever you extra removed on the asset side, where will it go? Understand, simple. Goodwill. Goodwill will come only because of investment in that instrument which is giving you decision making power. That is equity investment, not debt. So forget about that. Goodwill is no. If it is not goodwill, this basically 20 is representing what? 100 face value के investment I purchased it 120. Extra did I pay? The loss. Earlier reduces losses 2000 surplus. Right? So here other equity will be there. Extra 20 whatever you removed, bring it this side, adjust it to balance sheet. Now 120 on the asset side, 100 you remove from your debenture liability, extra 20 whatever investment is there, at 20 will not be recovered, adjust it to reserves. Officially not there, but exam came last 2 years back exam question. A question so many flaws are there, but this is not a flaw. The points are given here. Sometimes the receivable payable amount may not match due to cash or check in transit. Okay, this is not this one. First one is see. We should eliminate receivables payable within the group. If any gain or loss arises on cancellation of investment in debenture and debenture liability, such gain or loss be recognized in good cases. Cash in transit, what it says. But here you understood all the points. What all did we discuss? We discussed revaluation profit. We discussed the impairment already per a small point. And now just now we discussed the elimination of intercompany receivables payables. See, now that we are talking balance sheet, we have to remove intercompany receivables and payables. If you are talking about P&L account, you should remove intercompany incomes and expenses. Similarly, cash flow statement also intercompany items you should eliminate. Intercompany receipts and payables not be shown in group cash flows, depending on which part of financial statements you are doing adjustment. Next. There is something called as a time adjustment of profits. This 1/4/2022, the beginning of the year. End of the year is 31st March 20. Beginning of the year, subsidiary company has got a retained earnings of 10,000. Here ending, they are having a retained earnings of let us say 15,000, which clearly means that during the year they made a profit of 8,000. Who's one company called E.Srinivas Limited. Our company E Limited purchased shares on middle of the year. This happens to the So you have to tell me only one small point. What is retained earnings balance on the data? Why do you want this? Why do you want? What is the question? Pre-acquisition profits I want? No. Pre-acquisition profits, if I add it to share capital, then only I will get net assets on the date of acquisition. So I definitely want pre-acquisition profits on the date of acquisition. Tell me, sir, how to identify this? Tell fast, mathematically. Sir, tell me, if 10,000 is pre or post? It is definitely in the current year, subsidiary totally earned how much profit? If the 8,000 rupees is pre or post, both are both. In this, if no information is true, you will simply allocate the profit based on time, assuming the profit is uniformly earned throughout the period. So 8,000 is earned for 12 months, means for the first half of 6 months, can I presume that subsidiary earned a profit of 4,000 here? So 10,000 is pre, if 4,000 is also, whereas the 4,000 which is earned here, that is post. The answer is these two, 10,000 plus 4,000. You understand up to here? Small change. Date of acquisition 148. Date of consolidation is date of acquisition here. Only the last 6 months is post, first 6 months is still pre. Retained earnings balance, we give 10,000. Using retained earnings. So, what is the total profit earned during the year? Up to its basic. So, adjustment is. There is a fire accident here, subsidiary company, and they suffered a loss of your question is same. Your question no change is not. Tell me retained earnings on the data. The calculator convert. How to present this in the step I will tell you. Maths, what will it do? Tell. What, I'll give you a small hint. If the company earned 14,000 rupees profit in the current year, how much is earned in the first 6 months? That's normal thought. If it is that simple, why will I ask you the strong answer? 3, so you earned how much? 4,000. Okay, how did you get that? Thousand is a loss in post-acquisition period. But that is not the only loss, and they would have earned some profit also in post-acquisition. Okay. Okay. Get this. When you take current year profit 14,000 and do into 6 by 12, you'll get an amount of 7,000. Why this is wrong? Understand first, then you'll automatically understand how to do the correct thing. If 14,000 calculation is loss already considered, that means some X amount minus 1,000 loss is 14,000 into 12. Some answer you are getting 7,000. When you take the profit as it is, indirectly, the abnormal item, whatever is there, you are presuming that abnormal item also happened throughout the period. True or false? False. It happened exclusively in one period, either pre or post. In this example, it happened in post-acquisition period. Correct, no, sir? So, what is the mistake that happens is, of 14,000, abnormal item will be there. That also gets averaged throughout the year. That is wrong. We should not take 14,000 for average purposes. So, what should I do? Take 14,000. In this abnormal item is there. Nullify it. Add back loss. How much? Total is now how much? The current year final profit. This is current year profit without abnormal loss. This is the original profit which is earned throughout the year. Split it. First 6 months, last 6 months. First 6 months 10,000, last 6 months also half I did. Now you realize that a loss exclusively belongs to post acquisition. The question gives pre-level you will manage, no big deal. Okay. 4,000 rupees, 10,000 rupees, free. But on 1,418 already 10,000 is there. That plus this total it is equal to 3,000. When you are doing time adjustment, be careful that abnormal items will till date never pay. Will come, it will come, just a matter of time. Cadimat, RTP, not there. PA final, AS based question came earlier many times, it will come. Whatever last time parent subsidiary associate, are the old question. What is in waiting is foreign subsidiary. It's a matter of time. These are all the questions which ICA has up their sleeve. Unexpectedly they throw. Once it comes, no, then it will be there everywhere, then it will not come. You should be pragmatic, sir. Consolidation looks big and all, but this concept. Now the question is storying how to present it while doing our steps. Simple, very simple. Look at this. Step number 1. Date of acquisition. Changes called. Date of consolidation. Date of acquisition is 1/10/8. Consolidation date is set. Changes column is only for how many periods? The post acquisition period. Question ka data. Copy the share capital. For the share capital, usually problem will not be there. Then question gives you retained earnings. Closing retained earnings, same data you will take, which is 24. Now, obviously, like how I asked you this question also will not tell you this. So with this 10,000, how to get this 20,000 answer? Let us see. Retained earnings Whatever they give you, write that only. They give you as how much? But this is on which date? 1/4. The date which you want is 1/10/8. Just remember that. Balancing. This 14,000 is not for 6 months. This is for, forget about share capital for a moment. If 14,000 low, one problem is that there is a problem. Abnormal item. Go and adjust that. Add back. How much is abnormal loss? Once you add back the abnormal, this is correct profit now. For how many months? Now go and do time adjustment. 20,000 rupees, 12 months profit. In that, 6 months profit is pre in nature. Remove it from second column and add it to the first column. Already 10,000 is waiting for. Totally it will become. Now come to second column. Second column now became how much? This is now how many months profit? 6 months profit before adjustment of abnormal loss. Now remove of how much? Correct post acquisition profit. Correct pre acquisition profit. Your always control point is what you know. When you add these two, closing balance should come. 20 plus 4 is how much? Sir, mathematically, if you are able to understand what is happening, printing in this is big deal. With time adjustment. Time adjustment, when you have to do this, when acquisition happens during the year. And question does not provide you with retained earnings balance on the date of acquisition, but they have given you retained earnings balance at the beginning of the year. So first 6 months ka profit is also pre in nature. A first 6 months calculate jesi, the middle column you remove and put it in the first column. You get transfer for the profit. With time adjustment. You able to understand what is happening? Easy only. Again, when you see the story here, what we wrote. See how we wrote here. Calculate the changes column in retained earnings in the statement of net assets. Add back appropriations, dividends, and uneven expenses or incomes. Uneven expenses or income means no abnormal loss kind of thing, which exclusively relates to a particular period. Compute the profit relating to pre-acquisition period, assuming the profits are earned evenly. 10,000 into 20,000 into 6/12, whatever, that one. Give the effect of uneven expenses or incomes in the appropriate period. The abnormal loss in this sum, it happened in post. So we removed from post. If it happened in pre, we would have removed it from pre. All these are there, sir, in the question. So we should be prepared for all this. Next adjustment will be dividend. Before a dividend also we can discuss. But dividend, we need to do a question. Let's do one thing. Let's do the small case first, then we'll come to it. Next adjustment is unrealized profit in transactions between parent and subsidiary. Now look at this. In this also, for some reason, people get confused between eliminating unrealized profit and revaluation profit. First of all, clearly understand. Why do we do revaluation of subsidiary assets? Reason I want. Tell me. Why do we do revaluation of subsidiary assets? Do we do revalue every year? No. Is my goal is to follow them Ind AS 16 and all? No. My goal is fair valuing the assets and liabilities of subsidiary on which date? Acquisition date. With what motive? So that goodwill will be correctly computed. And this is done in accordance with Ind AS 103. Here with the revaluation you have to do. Otherwise goodwill number will be wrong. So revaluation profit that will not be there in subsidiary books. But consolidated books will all will come. Revaluation profit will come. Additional depreciation. All this will come. Whereas what we are talking now is unrealized profit between parent and subsidiary transactions. What is this? After our relationship has been established, you and me, we both belong to the same group, but we are having two different legal entities. As a result of this, any transaction that happens between parent and subsidiary, in that any profit is recognized. A profit, individual company point of view, that is correct only, but group point of view, a profit may be a unrealized profit. I cannot sell goods to you and say that I earned profit when you and me belong to the same group. Suppose, sir, this room is one company. The adjacent room is another company. I sold goods to that other company. So where are goods? Other room, no goods are there. In my books, profit is there. When I prepare financial statements of this room alone, a profit is correct. When I say that I will prepare consolidated profit, my room plus adjacent room, both put together, big room ka balance sheet if I am preparing, financial statements I am preparing, the moment I remove this wall in between, what is happening? This entire thing is a single entity. Where are the goods now? There only. Profit is recorded here. Did sale happen from group point of view? Did group as a whole sell the goods to somebody outside the group? No. When group did sell, when sale did not happen from group point of view, profit whatever you already recognized is a unrealized. Unrealized profit has to be correct. Now, to eliminate this unrealized profit, to accounting entry point of view, you think effect will be very simple. You have to reduce the value of the stock to credit stock. Why should you reduce the value of the stock? Cost for me is 100. I sold stock to that fellow is 120. That fellow books low, stock is appearing at 120. But group point of the stock should appear at 100. Cost to the group as a whole. But definitely have to remove from the stock. Debit what? Profit where did you record? When I sell, profit is recorded where? In my reserves, P&L account recorded. So go and remove from your PRL. While doing consolidated balance sheet sum, you have to remove it from end earnings. Next question. Whose PRL I should remove? Parent PRL, subsidiary PRL. Simple. Who sold goods you see? The parent sold goods, remove it from parent PRL. Subsidiary sold goods, remove it from subsidiaries post acquisition profits. Whoever sold that fellow's P&L you have to remove. Now, coming to our steps, look at this. If subsidiary sold goods to parent and you want to remove unrealized profit, you have to remove from whose P&L? Subsidiary's P&L. That to which profit? Post acquisition profit. Subsidiary P&L post acquisition profit will come into my hand in which step? Step number 1, the middle column. Middle column immediately here you got balancing. Here you should not remove and all. First you have to properly work out post acquisition profit. Yeah. You understand? So just to be, you should not by heart that I should remove from second column. Not like that. Post acquisition profit let remove. Every time a balancing figure is not post acquisition profit, for that adjustments will be there. Dividend adjustment will be there sometimes. Sometimes you have to do this time adjustment. After doing all that, once you clearly establish that this is post acquisition profit, from that you have to eliminate. Yes, sir. When subsidiary sold goods to parent. When parent sold goods to subsidiary, profit is recorded in whose books? Parent books. Parent ka profit will come into my hand in which step? Step 4, other equity. When you are writing, first item you will write balance in parent company retained earnings. Then you should. Here, last question in this. For example, is there, but last question. So, the P limited balance sheet, the subsidiary balance sheet, standalone. Stock cost 100, selling price 150. Parent sold to subsidiary. As a result of this, in parent's PRL, profit of 50 is recorded. Balance sheet cost of PRL will become retained earnings. Subsidiary's balance sheet, since they purchase the stock at 150, it is appearing at 150. Here, when I do consolidated balance sheet and apply line by line addition, the stock will come here at 150. The retained earnings of parent also will come here at, what did we just now discuss? Wherever profit is there, unrealized profit, go and eliminate it. Eliminate. Of course, also you have to remove from. By doing this, what is happening? Cost is now appearing at 100. What is 100? Is cost to the group as a whole. And unrealized profit, whatever is recorded by the parent in their books, that got eliminated. Clear clarity is there, sir? Look at the issue. Issue is profit charged by the parent is 50. stock recorded by subsidiary is 150. But in the P&L of parent, 50 is not there. 35 is there. What happened to 15 rupees? Tax. Tax they paid. I sold goods to 50 profits are and then gone. Auntie will take 30%. No. 30% cut if you give it to her. 50 minus 15. 35 profit is visible. 35 profit when it is visible. What comes to consolidated balance sheet also is 35. Tell me how to do it. Now what is big deals are? 35 you remove. Correct? If 35 here definitely I will remove. There is no doubt in that. But this side I have to remove. If I don't remove 50, this won't come to the cost to the group as a whole. So right side you remove 50, left side you are removing 15 only. A 15 extra you have to remove. From where will you remove? Otherwise balance sheet won't tell you. So it's like we are forced to write an entry like this. Here are to stock. Stock removed it. Here we are getting adjusted only by divide. 15 have to go and create a taxes. Group point of view, you have to create a DTA. Means here you remove 50, again you put it in there. Sir, why should I create a DTA like that? Yes. Very easy. Yes. Sir, as on today, sale happened from group point of view. Yes or no? Group point of view, sale happened or did not happen? Who sold goods to? Parent sold goods to subsidiary. Group point of view, sale happened or did not happen? But individual entity point of view, happened. Individual entity point of view, did we pay tax also? But group point of view, the sale transaction is eliminated. But tax payable, how can they eliminate? A liability obligation is there, tax payable I cannot eliminate. That means, group point of view, what will happen is, even without sale happening, tax is already paid. Or a liability is recognized towards the tax. Means what, sir? Even before sale has happened, our company has paid a kind of an advance tax there. Okay. Subsequent year, when subsidiary sells this goods to somebody else, the time DTA has to be. So this is the story of previous property. In this one, last adjustment. Look at this. I am not talking about date of acquisition and all. In the current year, acquisition happened long back. On a one particular date, 1/4/20, carrying amount of plant, limited books. Further has a life of sold to limited. Parent is sold one depreciable asset to its subsidiary at a profit. So, parent recognized profit on subsidiary recognized and all this drama happened on 1/4/2024. I am going to the end of the year. By the end of the year, I check the balance sheet of the plant. Why is it appearing at 10,800? 12,000 rupees divided by 10. Depreciation 1200 they provided, it became 10,000. Subsidiary balance sheet. Balance sheet of parent. In the retained earnings 2000 profit is there. Is profit on sale of asset. Here also should not have. For discussion is this. End of the year when I prepare consolidated balance sheet. When I do line by line addition, the plant will come here at 10,000. Retained earnings 1000 will. What adjustment will I sold something at a profit to my subsidiary, or something is still there in subsidiary books only? So whatever profit I charge, that becomes unrealized. I have to eliminate it. We already did this for stock. It's depreciable asset. How much is the unrealized profit? You have to eliminate. Thought process should be like this. URB to be eliminated is equal. What is the profit charged originally? Correctly, 2000. Ideally, I remove 2000 only. But wait. Normally, if sale did not happen, how much depreciation I would have charged? 1000. But because sale happened, subsidiary charged how much depreciation? 1200. Correct? That means in this entire transaction, if you sum up, you recognize extra profit of 2000. That fellow recognized extra depreciation of 200. Profit wrongly increased by 2000. Profit wrongly decreased by 200. On a net basis, 2000 profit wrongly recognized, group point of view, 200 expense wrongly recognized, group point of view. So group point of view, how much profit overall wrongly recognized? 1800 only, not to remove it right here. The formula, whatever you are seeing, formula is profit on sale minus depreciation provided on profit. How much is profit charged? Subsidiary provided depreciation 12,000 asset. 12,000 of profit is how much? 2,000. At 2,000 how much depreciation did they provide? 2,000 into 1 by 10. This shortcut formula. Or I don't want shortcut, I want original version. Existing carrying amount of plant on date of consolidation. What is the existing carrying amount of plant on the date of consolidation? 10,000. Deemed carrying amount of plant on date of consolidation, if there was no sale. If sale did not happen, the plant would have appeared at what value? If plant already at the beginning of the year was having a carrying amount of 10,000. I simply would have provided 1,000 rupees depreciation. It would have appeared at, I want it to be at 9,000. But it's appearing at 10,800. Question also, waiting in the queue it is time. The pakka comes at 100%. No point in loving after it came. Time adjustment already tested. Dividend adjustment tested. Bonus tested. Abnormal item did not got tested. This did not get tested. Preferentials did not got tested. Tools are there. Foreign subsidiary did not come only. Foreign subsidiary will be a classic case actually if it comes. Can't try anything there. So you know. Otherwise, touch me not like this. So the rest of this. So this is that. So here this is about unrealized profit elimination. So entire summary, sir. When subsidiary charges profit to the parent, or parent charges profit to the subsidiary, our profit will be in the nature of unrealized profit if the asset still remains within the group. Our profit has to be eliminated from that fellow who sold the goods and also from the asset. If it is depreciable asset, then full profit you should not remove. A depreciation, some element, a profit to some element also has been depreciated. A net profit which is still there in the books. Oh yeah, or remember this. All this again. Formula, shortcut formula and all. In case tax rate is given, you have to create a DTA separate. Okay guys, now we have discussed unrealized profit. We'll move on to dividend distribution by subsidiary. Subsidiary dividend distribution story. Ultimate accounting means adjustment. What you have to do is very simple, but the logic if you want to learn, it will be little deep. Without logic also you can do, but in that case you have to literally by heart. Quickly listen and 2 minutes will finish. So imagine there is a subsidiary Y Limited. X Limited is the parent company and our holding here is 100%. Then now subsidiary declared dividend. You all can easily guess the entry of dividend. Entry of dividend is, first you have to debit to your retained earnings to directly, so generally retained earnings to dividend payable 100 and then dividend payable to. So from subsidiary books what is happening is profits are reducing, liability side, asset side cash is reducing, cash dividend. Who receives this dividend? Parent company. In parent company books they will write 100% subsidiary, full amount will come to parent company. Bank account dividend, dividend income will go into PRL. You write anything in PRL, what will happen? That will again travel to retained earnings in the balance sheet. Now, group point of view, observe overall what is happening. Here, retained earnings reduced, bank balance. Here what happened? P&L increased. P&L increase means ultimately that is retained earnings increased. So here our money is coming here. Means overall group point of view there is. So if dividend was not declared, how consolidated balance sheet will? After declaration of dividend also, consolidated balance sheet should and will look in the same other choice. So if dividend is not there, how TBS will look? After dividend also, dividend consolidated balance sheet should look in the same way. When it's 100%. Actually, I change this, not 100, just make it 70%. So make it 70% subsidiary. Subsidiary side story will remain same, but parent side they won't receive 100 now. They will receive only. So group point of view, what is the impact of dividend now? Their reserves reduced by 100, my reserves increased by 70. That means on a net basis, retained earnings reduced by how much? The profits reduced by. Their bank balance reduced by 100, my bank balance increased by 70. Overall, if you observe, bank balance also reduced. What is 30 by the way? Dividend given by the subsidiary to NCI shareholders. Right? Meaning what, sir? When subsidiary declares dividend, the impact on consolidated balance sheet is like some amount is paid to NCI. That's all. Between parent and subsidiary, whatever is there, your pocket money got disappeared, other money appeared in my pocket. We both belong to the same family. So family point of view, there is no impact. But outside the family, if you pay any money, that will definitely have an impact on the consolidated balance sheet. So from this, what you have to observe is, dividend declared by subsidiary will have an impact on consolidated balance sheet to the extent of bank reduction, the extent of dividend paid to with this amount that will. Whether subsidiary paid this dividend from pre-acquisition profit, post-acquisition profit, all that is irrelevant for you. Let them pay from anywhere. Impact is this. Desired impact is this. Group balance sheet for NCA should reduce. Group balance sheet for bank balance should reduce to the extent of dividend distributed by the subsidiary towards NCI. Impact we have to bring. Now the question is, impact how I will bring while doing my consolidated balance sheet. Earlier we did one question for understanding, explaining basic consolidation. What I do is, same data again I am taking. I am just introducing one small adjustment of dividend. Same data, data no change is not there. Balance sheet also same. Only thing is, I will make the subsidiary company declare dividend. This question only we solved earlier. Same question, see what is the data given. PP, 70% shares you have in subsidiary, current assets, share capital, retained earnings, opening balance, current year profit, closing balance, current liability. During the current year, S Limited declared dividend of 20% on interim basis out of their current year profits. You remember the previous sum. Current year profit actually they earned how much? 1800. But today in their balance sheet, current year profit column how much is available? 500 only available. What happened to remaining 1000? They earned, but again they have distributed it. They distributed. That's all. Prepare consolidated balance sheet. So this is a question on consolidation where subsidiary declared dividend out of the post-acquisition profits. Subsidiary declares dividend out of post-acquisition profits. What adjustment should I do while doing consolidated steps, consolidated balance sheet steps? So what adjustment I should do? Let us do and see. You don't write, I will give you this note. Step 1, date of acquisition, previous column. You will take the share capital of subsidiary. Subsidiary का share capital 5000. Subsidiary का retained earnings. Closing it is 2500. Once upon a time it is the balancing figure is 10,000. Tell me, sir, what is 500? Post acquisition. The question is, if 500 rupees is post acquisition profit earned or post acquisition profit earned and undistributed. Earned and undistributed. Actually earned is not 500. Actually the earned is 1500. Of 1500 they distributed dividend of 1000. So remaining 500 only is visible here. Are you getting it, sir? So how do you know they earned 1500? I only framed the question. No? Previous question I am showing you 1500. The question it became 500. 1000 rupees. Why it is disappeared? They distributed dividend. If you observe bank balance also I reduce 1000. Otherwise balance sheet will not tally. Okay. Now this thing you will have to distribute it. Whom? Parent and 70%. That will be 350 and step number 1. Sir. Come to this goodwill capitalism. Goodwill capitalism step is undisturbed at all because the historical number is 70% you paid an amount of NC 30% minus fair value of net assets on the date of the above step only are 7030. Like how you got earlier, same number is 5000. Will the change? NC for consolidated balance. NC on the date of acquisition 2001. Hereof post acquisition profit the below button amount. Total it is 22 will go into balance sheet. Other equity in CV. Retained earnings in parent company 18,000. Hereof post acquisition profit from subsidiary these numbers they prepare a consolidated balance. PP Current assets 2007. Share capital always parent company. Other equities current liability 35 4,000. This is my ultimate consolidated balance sheet. Balance sheet edit. Now compare this balance sheet, the balance sheet what we got earlier. What you will observe is, you have already solved that. Now you can open the balance sheet and tell me the number. PPE was how much? Goodwill was 5,001. Was 7,000. The number was 35,000. Share capital was 1,000. Is 1905. 55. So sir, where changes came? Cash balance reduced now by 300. NCI also reduced by 300. Current year they declared a dividend of 1,000. 1,000 NCI portion is 30%, 300 rupees. That extent NCI also reduced. That extent cash balance also reduced. That you can broadly think like this. When subsidiary declares dividend, group point of view, the entry is A2. Normally dividend declaration entry is standalone books. These are the entries what I wrote above. Group books separately will be maintained as CFS books. In that this is the entry. Already CBS is there. On that entry if you write, bank balance will reduce by 300. NCI also will reduce by 300. You need not do this whole stupid steps again. Already whatever consolidated balance sheet you already have, you did previously, no? On that entry overlap change. What will happen? NCI will reduce, bank balance will reduce. Khatam, it is ready. Again you need not start from the very beginning, step 1, step 2, step not required. Already balance sheet is there. On that entry if you overlap, in the desired balance sheet. Clearly here? Now, if you go and observe, what did we do for dividend? What did we do? What is the treatment? Do nothing. Not doing anything will give you correct answer. Whenever subsidiary declared dividend to parent out of post acquisition profit, don't do anything. Just forget that normally. Step 1, did I do anything extraordinary here? Step 2, step 3, think same only did. Naturally correct answer will come. So, if the question tells you that subsidiary declared dividend out of post acquisition profits, the point A not there for you. Forget about it, do the sum normally as if the point never exists. Here, small twist, let us see whether you can handle. Same story, dividend is not paid but it is payable. Dividend declared but not paid. If it is dividend declared but not paid, in the balance sheet you would have had a dividend payable. How much payable will be there for subsidiary now? 1,000. Since it did not pay, bank balance will be higher, but liability have to be created. Correct? Since dividend is declared, parent books they will be having a dividend receivable to the extent of, because I can recognize dividend income when dividend is declared. Today balance sheet loan, intercompany loans total 700 will get cancelled. The effective liability is how much? Effective liability will be only 300. That is representing what? Dividend payable to. Earlier we wrote one entry, no. It is NCI to bank. NCI to bank would be NCI to dividend payable. Interest. When dividend is declared but unpaid. It is paid, this is it. Are you understanding the effect, sir? This is which case when dividend is declared out of post acquisition profit. What's the answer? Don't do anything. Ignore it. Ignore it, correct answer will come. You try to mess up something, wrong answers will come. Don't do anything, correct answer will come. Here's one. Now, same data I will take. I will make subsidiary declare dividend out of pre-acquisition profits. In that case, how to do that also. Then overall summary we will take what is to be here. Again, data is same, sir. Total data same. Look at also opening balance 2000, current year profit 1500, but dividend is declared from opening balance. Acquisition happened at the beginning of the year, no? So this is definitely pre-acquisition profits. So dividend also the pre-acquisition dividend distributed. During the current year, S Limited declared dividend of 2000 from its pre-acquisition profit, prepare consolidated. Let us see this also how to do. To understand this or ultra pro. Answer is easy. Ultimately, what you have to remember, remembering part you leave. That is always easy. Very hacking and this logic only, and one logic which is not very straight. You will understand. Date of acquisition. This column, date of consolidation. Share capital. What is subsidiary share capital given? 5000. Now also it is 5. What is retained earnings of subsidiary now? Closing 1500. On the date of acquisition, how much were the retained earnings once upon a time? Observe closely. Once again, look at the question, especially this part. Subsidiary. How much reserve was there on the date of acquisition? 2000. How much profit did they earn in the post-acquisition period? 1500. Out of that, they declared dividend of 2000, but 2000 is declared from opening balance. So closing balance is now how much? 1500. Now, hand on your heart and tell me, a 1500 closing balance, whatever is there, here post. Totally post. Are you all understanding that? 1500 is completely post in nature. Now, when you put this in this schedule, what will happen is some disturbing numbers will come. Your middle column is coming as minus 500. It is showing that post acquisition you suffered a loss. Did we? You get a loss at post acquisition period? No. But his statement is showing us a loss. No? That means he minus 500 and the number is wrong number only. First of all, ask yourself why are you getting wrong number? But still, till now, whenever we prepared this particular note, always we were getting correct number. Then for a change we got a wrong number. Because, tell me this. You visualize a ledger account like this of the retained earnings. Opening balance is 2000. Current year they earned a profit of 1500. Out of that they declared a dividend of 2000. Closing balance is. Now what you already understood is the 2000 is declared out of opening balance. The closing balance totally represents current year post acquisition profit. That means in the closing balance, is there any amount of opening balance? The closing balance number, is there any amount of opening balance? When it is not there like that, how dare you to put 2? Closing balance 1500, already opening the 2000 is there, therefore now minus 500, wrong answer is coming. You know when you would have gotten correct answer? Today in your closing balance, opening profit is, had you written 0 there correctly, the number would have come balancing figure as 1500 perfect. You know, I can't do that. If I go and write 0 there, my net assets on the date of acquisition will be wrong number. Therefore, my goodwill will go for a toss. So, I cannot write 0 there. So, what was there once upon a time, that only I will write. But second column is getting spoiled now. Second column wrong answer. So, we will make an adjustment here. I will nullify that adjustment. What adjustment you have to do is, sir? First understand, realize that this is a to this wrong profit. How will you make it correct? Add dividend. How did they declare? Add that. To make this correct profit. The first column is also correct. Second column is also correct. But remember, you added one extra number called as 2000 rupees to your profits, consolidated process. Balance sheet will not tally unless you adjust it 2000 somewhere else also. Either asset side also you have to add or liability side again you have to remove. Otherwise consolidated balance sheet will not tally. It is where you stand now. In this parent's share, 70%. 0. 30% NCA share is second step. Or PC what I paid for my 70%, NCA 30%, that we remember the number. What is fair value of E number no sir, change should not come because of goodwill, sir, because of dividend. Just because subsidiary declared dividend after the date of acquisition, that should not impact the goodwill what you computed on the date of acquisition. Goodwill what you measured in factory. When I entered the company, a company goodwill was 5,100. No matter what happens later on, once upon a time goodwill will it change? Equal goodwill may change. But once upon a time goodwill factor, historical fact that cannot change. So goodwill of capitalism is that. Next, coming to NCA for, you should start with NCA on the date of acquisition. Originally we recorded how much? So that add share of post acquisition. Here comes your adjustment minus dividend declared by towards NCA. Subsidiary declared how much dividend? In that NCA fellow will receive how much? 600 you have to remove here. Why sir? I will tell you. First you have to remove. The question is, why should I remove? Mathematical answer, listen. I added 2000 here. To where I added? Profit I added. Profit is sitting on the liability side only. Consolidated balance sheet picture. Liability side, if you go and add 2000, only on the liability side. When the balance sheet tally, no? Not that. Asset side also have to add. Or liability side, you have to remove it somewhere. NCA is sitting where? Liability side. 2000 to 600 you remove here. Another 1400 reserves will remove. Fourth step. So 2000 profit I added. Again 600 I am removing in OCI. Sorry. 1400 I will remove in other equities. Ultimately balance sheet will tell you mathematical reason. Logical reason is this. Tell me, how did you get 2100? How did you get that? Yes, correct? 7000 into 30%. 7000, how did you get? Share capital plus pre-acquisition profits. Simplify this. 1800 is equal. When I entered this company, on day one, I know that out of the profits, I owe to NCA an amount of, and I already included that where in NCA on the data. Subsequently, what did subsidiary do? They declared dividend out of this 2000 only, and consequently, NCA people received how much? 600. When I was owing to you, I will show it as a liability in the balance sheet. When I paid it to you, still you are my liability. If I owe you, you are my liability. If I pay you, it is still my liability. So, E 2100, E 600 is there or not there? But I paid that 600. Since I paid that 600, my obligation towards NCA will. In logical reason. Mathematical reason is easy. Here you added 2000, you have to nullify 2000. This is logical reason. Here sir, this is, you have to compulsorily do this. You don't do this, sum is gone. Definitely have to do this. Second adjustment. In the first adjustment. First adjustment is second adjustment. Third adjustment. When you do other equity for parent company ka retained earnings, so you have to start. Retained earnings in P Limited. P Limited retained earnings, if you see here in this sum, 19,400. Take that. To that add share of post acquisition profit, which is, here comes the last adjustment. What you have to do is dividend declared by towards parent. Total they declared 2000. That I received, remove it. To remove it, aimlessly again come back to number of 1. Why should I remove from? Here we understood the logic. Here why should I remove? Mathematical answer very easy. Profit you added 2000, again you have to remove from profits only, otherwise balance sheet will not tally. Logical answer is this. Sir, what is the pre-acquisition profit of subsidiary when I entered into their business? How many 2000 subsidiaries have? Only one 2000 they have. Correct? Our 2000 ka fate in consolidated financial statements is what? Will die. Correct? Are they declared or not declared? Forget about all that. That is profit. Our profit was there when I entered the subsidiary. That is pre-acquisition profit. Should it die or not? Should die. It died already. Where? Step number 2. Goodwill capital reserve process flow is 7000 and whatever you are seeing. Our 7000 share capital died. Pre-acquisition profit also died. Correct? Now come to standalone level now. It is consolidated books. Leave it. Come to standalone books. Standalone books law. Subsidiary declared the 2000 profit is now declared as dividend. When 2000 profit is declared as dividend, in that 1400 will come to parent. Of 1400, what did parent do in their separate books? They called it as income. Put it in their PRL. That PRL only, now you are taking it into 19400 from where did you pick up? Parent ka standalone financial statements from 19400 you picked up. So what is already dead in consolidated books? 2000 rupees, so your share 1400. Of 1400 in standalone books you recognize it as income, but consolidation point of view that is not income. That is a pre-acquisition profit which you purchased by paying money and you already cancelled it. Where? Step number 2, you cancelled it. At 2000 or 1400 died already. What is already dead? How can you again call it as income? Sir, profit flow two types are. One is profit which is earned. One is profit which is purchased. Two types of profits are there. A 2000 rupees is purchased profit or earned profit? Purchased profit. Group point of view, consolidated financial statements, R2000, the 70%, 1400, since it is purchased profit, you already cancelled it. Goodwill calculation. But standalone point of view, a 1400 you are calling it as income because that fellow declared a income correct, SFS low correct. Group point of view, that is not income, that is not something which I earned, that is something which I purchased. So it should not be there in your other equation. But since it is already there, remove and put it. Logical answer. This is a total 3 adjustments. Adjustment number 1. Changes column, the moment you get the profit, balancing, to that blindly go and add pre-acquisition dividend. Sir, in some loan, since we have lot of data, you can clearly observe that minus 500 wrong number in equals. How do you know? Current year profit 1500 question was given. But the balancing there minus 500 is coming, therefore is wrong and you are able to observe. The questions what you see in your examination, if fully detailed P&L account nobody will give you. You will not get negative figure, you will get some positive number only. You don't even know that is wrong number. A small example, you understand it as a proof. Whenever subsidiary declares dividend out of pre-acquisition profits, changes column, the number will be a wrong number. How to make it right? Add back the dividend. Since you add back the dividend, that has to be nullified again in 2 places. Dividend belongs to whom? NCA and parent also. NCA calculation though, just parent ka resource calculation. To do these 3 adjustments, perfect answer will come. Now if you see the consolidated balance sheet, if I prepare, PP, same numbers are 23,000, change will not. Investment died, goodwill will come, 5,001. Current assets, if I show you now, 6,400 is 0. Answer is 6,000. Now total bill. Share capital. Only parent ka share capital. Other equity, compute 19, NCA 1950. Current liabilities 3005. Sum total will come, not interested. Now if you compare this with the sum what we solved before dividend, the numbers were like this. 23,000 is still 5,100. The number was how much? Earlier 7,000. No? The number was 10,000. The number was still 19,050. The number was 2,550. Tell me, sir, where changes are there? Cash flow 600 rupees change is there. And NCL also there is a change of what is 600? Total dividend declared by subsidiary 2000 by NCA share is how much? 2000 into 30%. To that extent, cash balance should come down, NCA balance also should come down. And rest of the numbers for change should not be there. You should not somehow bring 600 difference and spoil goodwill, other equity like that you should not bring. Rest of the numbers of change should not come. Only these two numbers will change. Our effect will come only when you do these three. Clear here? Right? The questions generally won't be ambiguous. They will give you enough clarity whether dividend is pre-acquisition or acquisition. Our problem will not be there, sir. They will clearly tell you. Post-acquisition, ignore it. Pre-acquisition, the three adjustments you have to do. Clear now? Suppose any worst scenario I am telling you. Question told you dividend, information is not very clear. Pre or post, clarity not there. Do all three adjustments. Whatever three adjustments were discussed, do all the three adjustments. But that is post acquisition dividend, and I go and end up doing all three adjustments. Don't I lose marks? This is the previous sum, sir. What we solved when dividend is declared out of post acquisition profit, we ignored it. Now see, I will consider it. I will add back dividend. Is sum 1000. As a result, the number would have been 15 plus 70% would have been 5. The number will be, come to step 3. Here number would be 450. Okay? And now I will remove dividend declared towards NCA. What is dividend declared towards NCA? Still my answer is, when I come to step number 4, 18,700 as it is. Here 1050 will come minus dividend declared 700 towards parent. All of this. Three adjustments, whatever are there, uniformly you can do for any. Then you can do P also. Want to play safe? Do all the three adjustments. The answer will be correct. Post answer. Full clarity is there. Post acquisition property. Perfect answers will be pure original answer. Study material they told everything else except this point. So ultimately how you have to remember is like this. Look at this, how we wrote in our material. Dividend declared by the subsidiary out of post acquisition profits. Alternative 1. Do nothing. No dividend adjustment in the steps of consolidation profit. Alternative 2. Same as second case. What is second case? First point. Add the dividend declared by the subsidiary to the changes column in step 1 in order to obtain the correct post acquisition profit. While computing NCA for CBS, deduct the dividend received by NCA to the subsidiary. While computing other equity for CBS, deduct the amount received by the parent from the subsidiary. Three adjustments. The three adjustments you can do for post acquisition dividend also. Think any way you have to do for our dividend. See, if you want logic this much time, don't want logic, only magic are 3 points you remember. 3 points. Plainly executed, pre or post, don't even think. Here, while solving questions, no, then you should be careful with it. Means issues will come like this. Means when you really sit and solve problems, no, doubts how you will get it. Date of acquisition, changes column, consolidation column. You have share capital. Imagine dividend is declared out of pre-acquisition profits and acquisition also happened during the year. The time adjustment is also there. This is 110.80. But the stupid question gives you retained earnings on 480. What a balance in 12 months. Actually, what I want is only for key type of first scenario number. You must realize that the moment question of pre-acquisition dividend is there, blindly remember this. Pakka wrong answer, sir. The wrong profit is not correct profit. Moreover, this is not the period for which you want profit. The two adjustments you have to make. What is that? For time adjustment here, profit ka rectification you have to do. Between these two, which one first? Unless you rectify, what's the point of doing time adjustment and changing profit from one column to other column? Correct profit go. How to get correct profit? Add back the dividend. The moment you add back the dividend, the answer for 12 months, this is not the period what you want, but this is now at least correct profit. Now you have to do time adjustment, but before you do time adjustment, abnormal item is there or not, you have to check. What is abnormal item? Fire accident, interest expense only in the post-acquisition period, this kind of stuff will be there. First time nullify. Then you will get correct profit for 12 months period without abnormal item. And that you have to make a time adjustment. Remove some profit in this column, put it in. Now this will be your correct post-acquisition profit. On this, you should start making adjustments now. Your stupid additional depreciation, unrealized profit eliminations, adjust. Just because you know them, starting you should not do. The correct profit of post-acquisition period profit. Then all this adjust. You understand that the order answers will be correct. Just don't even know where we made mistake. Here's the broadly this is what your consolidation. Now, one small bonus issue related adjustment is there. Immediate last exam not there, but before that, continuously for 2 examinations they tested bonus exam questions. Officially, not there in ICS study mat. Really, they should not ask, but they don't have any rules. Once it came in the exam, means it's part of syllabus now. You have to prepare it. You should be prepared for that. Now. The general concept will let's talk. Ultimately, what you have to do, we'll talk towards the end. General concept is like this, sir. Bonus from where is it declared? Bonus shares are issued from where? From the reserves. So, reserves are reducing, share capital is increasing. So, even though today a bonus shares issued by subsidiary name is share capital, but its core nature is what? The profit. Today, after issuing bonus shares, it becomes share capital. But before bonus issue, it was profit. Now that it was a profit, originally it is profit, a profit would be either it is a pre-acquisition profit or it could be a post-acquisition profit. We don't mind whether they declare bonus or not. Our treatment is not there for share capital. Our treatment is there for profit. Tell me, sir. Pre-acquisition profit ka treatment is what? We should die. Computation of goodwill capital. Post-acquisition profit should come into our other equity. That's all. Pre-acquisition profit, what will happen? Post-acquisition profit, what will happen? In the process of consolidation, if you are having clarity on that, bonus share is nothing but profit only, no. Bonus share capital is profit. Name change, who cares? Names are substance. Substance over formula. Same is share capital. Who wants share capital name? That is not money raised share capital, no. Profit became share capital. So even though its name is share capital, you will treat it like profit. Conceptually, overall, because of bonus shares impact on consolidated balance sheet. If bonus was not there, what balance sheet answer you would have got? With bonus also, same answer you should. Like how? With the dividend, without dividend, what is the impact? Dividend declared by subsidiary to NCI. That is the impact. Atla bonus also, if you consider, impact is 0. If bonus was not there, what would have happened? Our share capital would be still under the name of reserves. Reserves, whatever treatment we give, now also will do the same treatment. So with bonus or without bonus, answer lo change should not. Overall, if you have clarity, I will show some numbers. So go on following these numbers. I purchased 100% shares in subsidiary on a particular day. The PC what I paid is 6,000 rupees. When I entered the subsidiary का share capital is 1,000. Subsidiary का pre-acquisition profit is 3,000. Both put together, subsidiary का net assets is how much? Tell me, sir. For 4,000 net assets, I paid PCF how much? Goodwill is how much? Is not. Still here clarity is there. After 2 years, I made the subsidiary declare bonus shares. They declared bonus in the ratio of 1:1. That too out of pre-acquisition profit they declare. Tell me, ma, what will happen to pre-acquisition profits now? When I entered, it was 3,000. Now out of the 3,000, 1,000 rupees bonus share capital is issued. What will happen? Pre-acquisition profit from 3,000 it will come down to 2,000. Share capital from 1,000 will jump to 2,000. So if somebody asks you, what is the net asset on the date of acquisition? How will you give me the answer? You will tell me 1,000 plus 3,000. Once upon a time. Once upon a time numbers. 1,000. Ignoring bonus. Consider bonus and tell. If you consider bonus, what is the answer? 2,000 share capital, 2,000 pre-acquisition profit. My answer anyway will be same only. So whether you consider bonus or you ignore bonus, answer will change will not. Yes, sir. The net assets on the date of acquisition is something which should not come. Follow this balance sheet. First case alone we are talking. Bonus shares are issued out of pre-acquisition profits. Let's completely execute this. Then we will come to another case of bonus shares issued out of post-acquisition profit. I can take a normal sum also, where bonus is one additional adjustment. If I take that kind of question, you will not understand what is happening to bonus ka profit. So I am taking an exclusive question where adjustments are zero, except this way clearly you will be able to understand and remember how bonus works. Look at the balance sheet, sir. Consider the following balance sheet of A and B on a particular date, 2023 ending balance sheet. Assets are given, sundry assets. Investment in 80% shares of P Limited is there, 1,800 rupees. Share capital, 5,000, 1,300. Opening balance, here beginning balance is 1,500, 600 of the retained earnings. Current year profit earned is given. Bonus shares issued in the current year is 300. Who issued bonus? Subsidiary issued bonus. How much? 300. Which means, correctly observe, how much is share capital today? Subsidiary ka share capital is how much? 1,300. That 1,300 is after declaration of bonus. So if bonus was not declared, how much share capital would have been there? But after bonus it became 1,300. You must understand the impact here. Okay, continue further. Sundry liabilities. A Limited purchased 80% shares at the beginning of the year for 1,800 rupees. By the end of the current year, B Limited declared bonus shares of rupees 300. Prepare consolidated balance sheet of A Limited and group assuming that first case, subsidiary issued bonus shares without pre-acquisition profits. Case 2, you forget about it right now. Only case 1 we will talk. Okay? This is your question. Now, what is our step number 1? You will have date of acquisition column, changes column, date of consolidation. Here 1/4/20, 12 months period, first March. Share capital. As on today, share capital is 1,300. When I entered the company, how much was share capital? There is a balance of 300. Balancing. This is what, sir? Share capital issued during the post-acquisition period. Correct? Come to retained earnings. See the questions. When I entered, how much retained earnings was there? How much profit did they earn during the period? 400. Overall, they declared a bonus of 300. Closing balance is how much? 700. When I post all this, the closing balance is, when I entered, how much was there? Balancing figure is how much? Total this. What is 400? What is 1600? Net assets. Once verify in the balance sheet whether the numbers are matching or not. Today's share capital is how much? It is after bonus. Before bonus, how much it was once upon a time? 1000. Today, once upon a time pre-acquisition profits are how much? Once upon a time share capital was 1000. 1000 plus 600. Okay, with the same answer or different answer? Moreover. What is the post-acquisition profit they earned? How much did I get? What extra adjustment I have to do? Bonus scheme, what extra adjustment I had to do here? You tell me, did I do anything extraordinary? I did not do anything. Closing share capital I wrote. When I entered how much share capital is, I wrote that. When I entered how much retained earnings was there, I wrote that. Closing retained earnings I wrote. Balancing good this. Everything is hereafter what will happen? Every time what will happen, that only will happen. Goodwill capital reserve. Other equity. Balance sheet nicely will tie. Won't change. You need not do anything again. Need not do anything. Literally nothing you have to do. Yes. Bonus is declared out of the acquisition. Not do anything. Everything will be perfectly correct. Imagine, as a subsidiary bonus say declared dividend. You know how this working note will appear in that case? I'll write in black color. This would be 1000. This also would be, gap will be, correct? The amount would still be, the amount would have been, the balancing figure would have been, total still would be 400, the total. Are you understanding, sir? Whether that fellow declares bonus out of pre-acquisition profits or not does not have any impact on our. Are you clear here? You know, I'll tell you one case. If you are able to guess this, you will get lot of confidence on myself. Subsidiary declared bonus shares 300 out of pre-acquisition profit. Same question, but subsidiary did not write entry for that. They declared, but they did not write any entry for that. Since they did not write any entry for that, the balance sheet is not appearing like how we are seeing on the screen. Balance sheet, how will it appear? Is appearing as 1000 here, 600 here, 400 here. The total is appearing as 1000. In the process of consolidation, will you sit and write that entry? What will you do? What will you do? Consolidation, what will you do? They declared bonus, but subsidiary did not write entry for that. What will you do? This is what the black color is what is there in the question. That is wrong, I know. But consolidation process law, you should leave it. Don't do by, even if you don't do anything also, answer will be same. You should not go write entries and all, that is waste of time, because even if you write entry also, that will still die. Or our bonus capital is issued out of pre-acquisition profit. Pre-acquisition profit will die. Our share capital. If you don't declare bonus, then it is there with the name of pre-acquisition profit. If you declare bonus, it will be there with the name of share capital. Share capital also will die, no? Pre-acquisition profit also will die. So whether it is with the name of share capital, whether it is with the name of pre-acquisition profit, it doesn't make any difference for us. It will anyway going to die. So in any way it is going to die, why should I go and rectify it? This question came 2 times in the exam. All you have to do is, question of 3 lines they gave. Company issued bonus shares, so and so, E-ratio, but subsidiary did not write any accounting. It's as good as a point and not there for you. Peacefully. Sitting in a subsidiary declared bonus shares. Blue color answer. Had they not declared, black color answer. They declared and did not write, still same answer. Declared also same answer, not declared also same answer, declared but not written also same answer. Why will you go and write an entry unnecessary? Don't complicate stuff. Right. So this is the correct answer. When bonus shares are issued out of, coming to the, this is dangerous one. If this is dangerous is standard law not given anywhere. How to do treatment? Example never came till now. Ind AS. 2 times question came. Both the times pre-acquisition they have given. The question is silent also, you have to assume like that only. But if the question tells you that bonus shares are issued out of post-acquisition profits, how to adjust idea? That I am discussing on for example. Follow this correctly. The subsidiary share capital is 1000 when I entered. Date of acquisition. Subsidiary का retained earnings 2000. For convenience, assume 100%. It is when did we compute this? On the date of acquisition. After 2 years. I am showing you that 2000 is free, plus the subsidiary fellow earned post-acquisition profit of. Out of this post-acquisition profit, they declared a of this. So closing retained earnings is 2000. Share capital now it is 1000. What is the net assets on the date of acquisition? The question is, how will you get 3000 rupees from right hand side data after 2 years balance sheet? Our data to 3000, how will you bring? 3000 is a fact. When I entered the company, net assets was 3000. Whenever you compute goodwill, you take 3000 only, not a rupee more, not a rupee less. But question one, nobody will give you this data. The number nobody will give you. This number you have to get. How will you get it? Simple. Date of acquisition. Your post acquisition cost. Date of acquisition. Start with this. Today's share capital is how much? Once upon a time share capital is post acquisition column balancing figure will come as coming to retained earnings. Closing retained earnings is 2004. Once upon a time retained earnings is balancing figure is how much? Got it? First column, how much did I get? Second column. Tell me, these numbers are right or wrong? Numbers are right or perfectly correct. What is 3000? Net assets on the data with proof. The numbers will naturally come. You need not do anything, sir. Natural. A format is like that. Created a format in such a way that post numbers correctly, whatever correctly has to come, it will come. It will not come only in one case. Dividend declared out of the acquisition profit. There we will do adjustment. Rest all cases you need not bother. See there. That fellow declared bonus shares out of post acquisition profits. Share capital changed off, but still our format will still give you correct perfect number of net assets on the data. Here, next. What is the post acquisition profit you got? 1000. Is 1000 correct number? Yes. How much profit did you earn? What did we give here? 1000 only you earn? No. A 600 you paid in cash to somebody. No. What did you do? You removed from reserves and you added to share capital. Even though today its name is share capital, its nature is profit only, no. But which profit is that? Post acquisition. And post acquisition profit ka destination is what? What will happen to post acquisition profits? It will be adjusted to our share will go into our other equity, NCA share will go to NCA. As simple as that. Till there clarity is there. Look at the final adjustment. Not adjustment, presentation. 3000 our share. NCA share. No problem. Normally 1000 should go there. Our retained earnings should go and add. What one guidance that is followed by ICA in their answer. In this 1000, is there some portion of post-acquisition profit is undistributable now? Post-acquisition profit is how much? 1000. But a 1000 is there in subsidiary ka retained earnings or some in retained earnings, some in share capital. Some in retained earnings, some in share capital. Means if it is with the name of retained earnings, it is revenue profit. But once they convert that into share capital, its nature changed. The profit, but it is no more a revenue profit, it became a capital profit. Since it became a capital profit, what we will do is, the 1000, whatever is share capital related profit, that we will show it as capital reserve. Remaining 400, whatever is there, that we normally add it to key point, standard low, not there. I say ka answer lo treat. I enter 1000 post acquisition profit. Adi parent ka other equity loke it will go. But when it goes into other equity, don't add entire 1000 to retained earnings. 1000 la how much is share capital portion? Adi capital items sir. After it became capital, how can you go and call it as retained earnings? It's an undistributable profit. Therefore, that portion alone you will describe it as capital. Remaining portion normally will go to retained. Or we can't think so much. We feel this is very, very heavy. Don't think. The entire 1000 is there. Add, don't describe it as retained earnings and all. Call it as other equity. Add it there. 600 also will go into capital reserve. 400 also will go into retained earnings. Both will go into the heading of other equity. You know, go last column, go and add it somewhere. If you are having doubt, retained earnings column, one column. Capital reserve column. General reserve column. So many columns will be there. Closing balances you will do. Closing balance ka total you will get. A total add this skill. Somehow that money has to go into other equities. That's all the goal. Keep recommendatory answer. And when it is silent, no, nobody can force you to do. Now you see how I executed that in this question. Once again, come back to the question. So assets investment all over, share capital 1300 it became, opening profit is 600, current year earned profit 400, bonus shares is 300. Now second assumption is subsidiary issued bonus shares out of its post acquisition profits. Now in this sum we are 80% shareholder. Okay, now if you look at the answer, this one. Okay. So when it comes to bonus declared out of post-acquisition profit, look at the answer. Share capital today 1300. First you write this. Once upon a time when you entered share capital was, the balancing figure will be bonus share capital issue. Current year closing, sorry, today's retained earnings closing is 700. When I entered, it was 600. E balancing figure, the total is 400. 400 is post-acquisition profit. The 400 80% belongs to us, 20% belongs to NC. Whatever belongs to NCA will go to NCA. Whatever 80% belongs to you, 320, this will 100% go to other equity. There is no doubt in that. If you are confused, don't do anything else. 320 is other equity, you add up. Game over there only. Nothing else you have to do. But you want to do perfect presentation, what you have to understand is, E320, how much is share capital included? The 400 what happened? 300 is also there, 100 is also there. 300 lo 80% which belongs to you, that don't add to retained earnings, that should be added to capital. That is the ideal treatment. 300 80% to 40 will be added to remaining profit, you can add it to retained earnings. The ideal treatment for this. No sir, I cannot think so much. Don't think. Go and add this to. Sir, then what is the special point? No point, no special point. Like how bonus declared out of pre-acquisition profit is ignored. Bonus declared out of post-acquisition profit also ignore, and whatever naturally happens, let it happen. Don't do anything. That fellow did not write an entry, you don't go and write an entry. Leave it. Moral of the story, bonus shares issued by subsidiary treatment is no treatment. Don't do anything. You don't go and mess up unnecessarily, create trouble. Last 2 times, many people went and disturbed that. The fellow will, as a trap, that fellow did not write an entry as a trap. Even if that stupid writes an entry, I will cancel it anyway. No share capital. Why to write an entry? Don't write an entry. Here when I came to the last part, E240 alone I put it in capital reserve, 80 I put it in earnings. You are confused. Who cares, sir? Enter 320 right here. Answer will change. Somebody is angry, they'll remove 1 mark. Oh no. Mark 1. Then 98 marks will. Keep it absolutely simple. Consolidation, like whenever you get stuck in consolidation, small dummy balance sheets you draw and see what is happening, what you want. Automatically answers. You end up by hearting everything. No, so new adjustment when it comes, no, is scary. Format is everything, exams you should not go. You should know the format after understanding the logic. If you understand logic, you yourself can create. Then all the formats also will help you. Make your job easy, but you should not be totally dependent on format. Most of the people, what they do, they'll see the answer and prepare a background format. That's very wrong way of learning things. Anyway, this bonus story, whatever I just noticed, this is also again there. Bonus issued out of pre-acquisition profit. No further adjustment is necessary as the net assets on the date of acquisition does not change. When it is issued out of post-acquisition profit, basically the subsidiary is converting its revenue profits into capital profits. Parent's share of such bonus share capital is to be reflected as capital reserve in the consolidated balance sheet. NCA share of bonus capital will be added to NCA. Or that and all you need not, naturally it will happen. Or although you don't do anything. With this consolidation, original fundamental base setting is over, sir. All adjustments are also over. Beyond this, till now never came the maximum. Now, further issues that we have to discuss in this. One is the chain holding case, and there are some small issues. First, small issues we will finish it off. Chain holding as well. Okay. Small issues are like this. 3-4 issues. Easy one. What's this? You are A Limited, subsidiary B Limited. You are having 90% investment. And since your parent company, you already prepared consolidated balance sheet. The consolidated balance sheet, NCA will be there to the extent of 10%. It is appearing at letter A. So what happened? A Limited purchase additional 10% in B Limited. 7,000. Already you are having 80% shares. Now you acquired another 10% shares. How will you account this? When you buy additional investment in subsidiary, will you get more control on it? I was already having full control. It's 80% only. But by buying another 10%, my ownership increased, but my control, there is no change. Control change is not there. Not be going and disturbing goodwill and all. Should not go and change goodwill number, capital reserve number. Don't touch that. Goodwill will not change because control change is not there. Now, how to do accounting for this? Yes. One accounting is very well known. SFS. SFS law to budget investment. For the entry will write investment in subsidiary account debit to amount of. Questions are there where they ask you so accounting of this in consolidated books. Consolidated books how will you account purchase or further investment in existing. Sir, today I am already having how much percent? Sir, 20 is there with whom? So I am buying extra 10%. For whom am I buying? NCA only I am buying, no. So because of I investing further in subsidiary, it is like I am buying back NCA by paying money to them. I am cancelling NCA only. So effectively the entry should be NCA 2 and very good. The account 2 and in this PAN portion we have clarity. The question is NCA how much I should cancel? Proportionately. Proportionate. Existing carrying amount. So proportionately I have to cancel. What is existing carrying amount? Go to existing consolidated. 20% NCA, how much is it appearing at? Today you purchase how much? But 10%. Yeah. Half. So 5,000 NCA you had to cancel by paying them an amount of 7,000. How much you paid extra now? How much extra did you pay? This is undoubtedly loss only, but this is a loss in a transaction made with equity participant of the group. Who is NCA? He is shareholder of our group only, no? With him only we did transaction, we suffered a loss. Loss cannot go to PRL. Own equity, the boys. Own equity fellow transactions cannot go into PRL. The other equity we have to adjust or retained earnings directly happily. So what if profit comes? Same answer, we go to retained earnings. Are you getting it, sir? Group point of view accounting important. Individual point of view, what is it? Here to you, the first case. Case 2. A holds 80% in B. The consolidated balance sheet of, imagine NCA 20% amount is appearing in the present state. A Limited sold 10% shares in B Limited for you sold shares. That means a 80% subsidiary now becomes a 70% subsidiary. Tell me, because of this, did I lose control? Did I lose control because of this? No. 80 became 70. Ownership reduced. Control? No change. When control the change is not there, do not touch goodwill. Always questions like ample data will be there relating to goodwill, fair value of asset. Don't touch. Only trap. Totally trap. Questions are there. Don't touch. All information is waste except NCA information. Okay. Now, what is the answer for this? Answer is simple. SFS means sold investment. Sold investment, it is bank account debit to 2,500. The proportionate carrying amount you have to cancel. Whatever carrying amount. Gain or loss will be there. That will go to your SFS. Consolidated books, what accounting you will do? You sold, so money came. Bank account. By selling shares, are you not increasing the NCA? Existing NCA 20, after this transaction NCA will be 30%. So you have to update the, or I have to increase NCA by how much? Proportionately, sir, proportionately. So 20% the NCA presently is 10,000. So further 10% if you have to increase, how much is it? But you receive 1,500 more. This is the profit made on a transaction with equity participant of the group. This also will go to directly equity. So whether you buy further shares in subsidiary or sell existing shares in subsidiary in such a way that control no change is not there, whatever standard tells is should be accounted as if you are doing transaction with it. And correspondingly, NCA should be either increased or decreased proportionately in relation to its carrying amount. Then clarity is there, pakka gain or loss will come. That gain or loss cannot go into PRL because the NCA is an equity participant of the group. It is adjusted to Dividend. Here now, clarity is there. In this one small issue is there, focus correctly. Consolidated balance sheet of A Limited. NCA 0%. Why 0%? A Limited holds 100% A Limited. So existing carrying amount of NCA is 0. Now, A Limited now sells 20% in so 100% subsidiary. You sold 20% shares. As a result, it is only an 80% subsidiary now, and 20% you have to create a NCA entry. SFS point of view, leave it stupid SFS, that is easy only. Group point of view, talk. Entry, sir. Half entry I will tell if you want. Bank account. Another half outside. What will you say? A proportionately increase, sir. like this. And do not. Earlier it was 20, I made it to 30. It's already 0. Carrying amount also 0. Proportionate increase for a drama will not work here. How to work out NCA number there? Circle. Measured now on don't have a choice. Compulsorily PSN ASC work out here. PSN how to work out? Take the net assets of as on pay. Difference. Created. NCR you are increasing creating 100% subsidiary first time measure this. Here, PSNA you wrote no. Fair value also we can do no. Not do PSNA. Why sir? You tell me. Why fair value option is given? So that you will measure goodwill correctly. Goodwill today you will measure. It was already measured on the data. Subsequently fair valuations are not allowed. The fair value should not be PSNA. Little more clarity. In net assets means from where will you bring? Which balance sheet? Company ka balance sheet. Our subsidiary assets and liabilities consolidated balance sheet look, they will come at some numbers. Numbers not subsidiary standalone. Assets may be revalued, unrealized profits may be eliminated. Our balance sheet lo what amount is it? That amount you have to take relating to subsidiary. Assets of liabilities in CBS. Not in the standalone stupid subsidiary books. On the books, no subsidiary assets and liabilities are appearing at what amount? Amount you have to take. Always that only. Not a new. My question is not this. Question is this. Can we include this or no? Can I include or no? Yes or no? The partial goodwill, full goodwill ka story hai, but correctly answer yes or no. That and all you think inside. You have to include goodwill. No, don't know. Don't get carried away looking at this. Why you have to include it? Let's think. Recap. Goodwill are you computing now? Already computed. When did you compute already? At the time when you computed first day, are the full goodwill or partial goodwill? I am asking on the date of acquisition when you computed goodwill, it was which goodwill? It is 100% subsidiary. Not forget the starting point. 100% subsidiary. Apply the template and see. PC. First day. Some number. NCA. Fair value of in questioning. The goodwill is full or partial. How do you know? The 100% shares ka fair value. The 100% net assets ka fair value means the 100% goodwill of whatever goodwill you already consolidated, the full goodwill of subsidiary. Full goodwill NCA also will have a share or not? At this time NCA was not there. Subsequently NCA is coming. So whenever you create NCA, since what you already have is full goodwill, our goodwill or share NCA creation also. So what I'm trying to say? Normally it's very easy to remember that NCA measured at PSNA means partial goodwill. NCA measured at fair value means full goodwill. That is not wrong, but that's not complete. Full goodwill, and why we are calling it as full goodwill, you must understand. 100% shares ka fair value is compared with 100% net assets ka fair value. That's why 100% goodwill. NCA is 0. Still it is full goodwill. Subsequently, NCA gets created. Still does not change the fact that balance sheet of whatever goodwill is appearing, that is full goodwill. In that, NCA also will get a share. So while computing or creating NCA today, goodwill should be included along with other assets. Getting importance of these are all small decision making which you have to do while making the question. Concept clear, everything will follow. Last case, plain subsidiary story except other than chain holding. This is my consolidated balance sheet. In this, so many assets are there of my company. There's so many assets you also have to copy it from subsidiary. Because you did consolidation, you will also is there. Only your share capital is there. Other equity is NCA it is. Liabilities of all this consolidation ka drama is there because parent controls. Imagine parent hold all the shares in. If parent sells all the shares in subsidiary, the relationship does not exist anymore. When relationship A does not exist anymore, should I do consolidation? Not do consolidation. When you should not do consolidation, the already consolidated books, whatever you are already having, that you have to properly close. Should not be asking questions like, anyway consolidation balance sheet I need not prepare, no sir, why should I write dummy entries? No. Sir, as an accounting person, you should know how to close books of accounts. For example, P entry lo purchasing company, selling company are there, amalgamation chapter. Selling company valuating account, a realization account and all. A company anyway dying, no sir, let it die on its own. I will go and do accounting in purchasing company. AS14 is applicable only in purchasing company books. Why should I draft realization account? Why should I draft equity shareholders account? Question like that. At that time we were innocent, sir, we did not ask. Now we are pro. Here we closing, you are closing because you should know how to close books of accounts. So is here also a consolidated balance sheet. How to undo the discussion. Whatever is not yours. All these days you thought that you both are together forever. Breakup happened. It happens. So breakup happens, you have to undo, no? Process it. What entry will you rate? Group point of view. If it's standalone point of view, bank to investment he will rate. That I am not discussing. Insulting you. Bank account debit, whatever money you receive, that one. All assets, their assets you thought they are your assets. Their liabilities you thought your liabilities. You both combined the thought of goodwill. Thing disappear. From outside NCA is there. The entry pakka will not tally. This gain or loss will come. That will not go into retained earnings and all. That fellow is outsiders now. The person to whom I sold, he is not my equity participant, he is some outsider. This time gain or loss will go into the sale of shares. Earlier discussed the sale of shares. The sale of shares without impacting control. The sale of shares or disposal of shares in a way control is getting impacted. Loss of control, gain or loss will go to pure. Yes, sir. In this one more twist. Sometimes after breakup also friendly relations will be maintained. 100% subsidiary, 80% sold, 20% still retained. Still control is lost. Maybe they are in marriage process, but still you are in friendly terms. So entry of change will not be there. One extra investment in X. That 20% whatever you are having, sir, recognize that. Then determine the gain. Yes, sir. maximum. Okay, one more case is also there, that is, there is a company, sir, a company 50,000 shares are there. I am holding 60%. 50,000 and 60% is 30,000. Major shareholder I am owning. I am parent, the other company is subsidiary. I am having 30, outsiders are having 20. The stupid subsidiary, without my approval, issued shares to outsiders in such a way that outsiders became majority, I became minority. So all these days you thought it was yours, subsidiaries. So I did consolidation, but she had other plans. So you are not part of the bigger picture. Control is missing now. So all these days, whatever consolidation you did, now you should not. Then also, in this case, I did not sell it. So you will not have this part. Bank will not. Your investment is now whatever, once upon a 60 times 60, now you are 40. 40% of fair value rate. Gain or loss will still go to. All these stories again I have written. This is without affecting control, NCA ka impact. I told you that when it's a 100% subsidiary case, we have to create NCA including goodwill with a percentage. If control is lost, complete investment sale, partial investment sale, two cases. Complete investment sale normal, partial also normal, but partial case investment return must be recognized at fair value. Gain or loss will always go into, on this also question. So many assets of subsidiary are there. So many liabilities of subsidiary are there. All this you consolidated. The other equity, sir, your retained earnings is there. To that subsidiary ka profits you added, your share of course. You have revaluation surplus. I am not talking about revaluation on the date of acquisition. I am talking about Ind AS 16 wala revaluation surplus. Who revalued their asset? Subsidiary revalued. Subsidiary books lo revaluation profit is there. That is post acquisition profit. Whatever revaluation profit is earned after I entered, in that my share you are solving. This kind of question, full consolidation, quite unfortunately your study material does not have. None of the EC resources have. What is this? You know, we are always talking about what, sir? Post acquisition profit into which account you are searching that? Retained earnings, so you are searching. Post acquisition profit ka by general plain English meaning is what? Every profit earned by the subsidiary after the date of acquisition is post acquisition. Is there any rule that profit should be earned only in PRL section? Huh? Profits can be earned in OCI section also. Suppose if I show you the SPL of subsidiary post acquisition, PRL section 1000 is there. OCI section they are having 400. 1000 also post acquisition, 400 also post acquisition. If 400 rupees, the reason I am telling you, in this revaluation surplus is there, some debt instruments are there which are measured at FETOC 100. Imagine hypothetically for ease of convenience, 100% subsidiary accounts. So what happened, since that 400 also is a post acquisition profit, what I would have done, the 400 also would have recorded here. One revaluation surplus I would have recorded and one fair value gain on debt instrument also it should have recorded. Now I sold off shares in subsidiary. Since I sold off shares in subsidiary, the assets will go away. The liabilities also will go away. What will happen to these OCI items? What will happen to OCI items of subsidiary which are existing in the consolidated balance sheet when you sell the shares in subsidiary? Full question. Our gains are realized or unrealized? Realized or unrealized? Sir, if any small points, questions are there, dangerous, very dangerous. Okay, I'll put it, forget about this. I'll put it a much more easier way. Let's try again. I am subsidiary. You are parent. You are parent, I am subsidiary. The subsidiary books lo one land is there. Land is there. When you entered, the land ka value is 10 lakhs. You stayed as a parent in my company for a period of 1 year. In 1 year, sir, the land value from 10 lakhs went to 15 lakhs. Our company follows a revaluation model. So books lo also subsidiary updated. From 10 lakhs I made it to 15 lakhs. 5 lakhs where did I record? Revaluation surplus lo I recorded. That is post acquisition profit. You also copied that revaluation surplus. Here, visualize now. In your consolidated balance sheet, revaluation surplus is there or not there? Your consolidated balance sheet, it is there. It is actually revaluation surplus relating to land of subsidiary. But since if 5 lakhs profit is earned after the date of acquisition, its nature is post acquisition profit. Therefore, parent also consolidated that. It is appearing in parent ka consolidated balance sheet. Correct? Tell me. The profit realized or unrealized? Unrealized, because land is not yet sold by the subsidiary. But after 1 more year, you parent, you sold of the shares to some other party. When you sell the shares to some other party, will you sell at the price at which you bought? Will you sell at a higher price? Higher price. Why? Why, sir? Common sense. Common sense, okay. But when you entered my company, land value was only 10 lakhs. But in this 1 year, land value jumped up by 5 lakhs. So whoever comes into your place, that fellow will have that gain. So you want to recognize that gain. So what will you do? You will sell that shares at a higher price, recovering this land value also. Means, even though subsidiary did not sell the land, as a parent you sold off the shares. Therefore, for you, a gain now becomes a realized gain. Now that the gain is a realized gain, it cannot sit under OCI. When it cannot sit under OCI, where will the gain go? The gain will go to that place where it go normally if it was your own OCI item. Revaluation surplus, so OCI item. Reclassifiable or non-reclassifiable? Non-reclassifiable. So, this subsidiary ka revaluation surplus which you copied also is non-reclassifiable only. We directly merge into retained earnings. On the other case, fair value gain on debt instruments created in Ind AS 109, reclassifiable. That will go to subsidiary books. Actual loss is there or actual gain is there on account of the PVDBO created on retirement benefits that you copied. Now you sold shares in subsidiary. Now the gain is a realized gain for you. As a reclassification, not allowed. Directly merge it into FCTR, reclassification allowed, merge it into. So whatever will happen to your own OCI items, same treatment you will give for subsidiary ka OCI items which are present in your consolidated balance sheet when you sell off the shares and subsidiary. On this one, beautiful question. 80. Came in RTP also, MTP also, study mat also recently they added, but exam did not become. A question if you have to do, apart from knowing this concept, you should very clearly know which OCI items are reclassified, which OCI items are not reclassified. So 5 points, or 5 points the fellow will ask you to write. Very interesting question. That is that. Okay, this the last aspect in subsidiary consolidation is chain holding. Chain holding is a relation where you have a subsidiary, that subsidiary has another subsidiary. So in this sum it is like X is having shares in Y and Y is having shares in Z. Once upon a time, the questions when they used to come in CA final, how ICA used to do this particular adjustment is, they used to consolidate Z into Y first. Then this fat Y they used to consolidate into X. The step by step consolidation they used to do. The least subsidiary will be consolidated into middle subsidiary will be consolidated into topmost subsidiary. Once upon a time they used to do like that. But in this Ind AS, whatever your syllabus is there, they changed the methodology of consolidation of chain holding. In fact, whatever method we have now, that is the most easiest way. Today's process is like this. In middle subsidiary is there, that will be directly consolidated to the top subsidiary. That is normal. In last subsidiary, who is the parent? Y. Even though Y is the parent, we consolidate Z also directly into X on the basis of something called as an effective holding. Effective ownership and a concept. So Z also is directly consolidated into. So as far as consolidating Y into X is there, nobody will have any doubt. Z when I am trying to consolidate into X, some small doubts, ambiguities will be there. So the objective of this discussion now is, there is a question in study mat. This is our examination question, study mat question. So each question detailedly we will discuss and show the solution. The process will understand the three adjustments what you have to do when the chain holdings are. Let's read the questions directly. The study mat is there, sir. Don't worry. Given below are the balance sheets of the group of companies comprising of X, Y, and Z on 31st March 2022. We have PP, investment in Y Limited, investment in Z Limited. Y Limited investment is appearing in X Limited balance sheet. Z Limited investment is appearing in Y Limited balance sheet. X in Y, Y in Z. We have inventories, trade receivables, bills receivables, cash and bank. Look at this. Look at this. Bills receivable, trade receivable, separately is giving. Bills receivable is part of trade receivable. Just because question they gave like that, answer also if you write like that, you lose marks. Bills receivable should be merged into this part. Okay, coming to share capital, reserves, retained earnings, trade payables, and there are some intercompany bills payable and the following additional info is also available. X Limited holds 80% shares in Y. Y holds 75% shares in Z. Their holdings are acquired in the middle of the year. During the year only, but middle. The business activities are not seasonal in nature. Why are they saying not seasonal in nature? Is a time adjustment happily you can do. But at the beginning of the year, the following are the balances in Y Limited and Z Limited. Here beginning balances they gave you, but acquisition happened middle of the year, so time adjustment is required. And this time they don't have one profit, they have two profits. One reserve also they are having, retained earning also they are having. Fourth point, 35 lakhs is included in the inventory figure of Y Limited, which is purchased from Z Limited at cost plus 35%. Who sold to who? Last subsidiary Z sold to its immediate parent Y. Profit is recorded in whose books? Profit is recorded in the books of the person who sold goods. So Z P&L you have to remove. But where you should be careful is to remove from Z post acquisition profits. So there is a time adjustment. After doing time adjustment, you have to eliminate. You are required to prepare consolidated balance sheet of the group of the companies X, Y, and Z. Now, you put your focus only on the chain holding related adjustments. Don't sit and focus on cancellation of intercompany owings, cancellation of unrealized profit and all. They are all normal, that anyway you understood. Chain holding the extra what you have to learn. Listen sir. Question ka data how they gave is X is having 80 in Y, Y is having 75% in Z. Okay. Subsidiary Y ka consolidation to nobody will have any problem. Y will happily be consolidated into X like just like any other sum. Then how to consolidate directly into topmost parent company. You have to work out something called as effective holding. Effective holding means Y is having 75 in Z, but X is having 80 on Y. So from X point of view, X has how much ownership on Z? See, Y ka ownership on Z is how much? But X ka ownership on Y is 80. Is 70 power 80%. Is how much now? So you must understand that because of this chain holding relationship, he is effectively as good as topmost company X is 60% owner of the bottommost company. Means remaining 40% is NC. Sometimes possible that this 60% place to you may get 48% or something 40%. Still that is parent only. The effective ownership. For example, here instead of 75 it is 60%. You will apply 60% into 80%, 48%. Should not say 48%, no, how can you be a parent and all? No. It is not voting power. The effective ownership. Tell me, sir, can Y control Z or not? And Y will do exactly like how X wants Y to do. Ultimately, X is able to control Z or not? Or Z meeting is happening. Who will win? Whatever Y says, that only will happen. And what will Y say? Whatever X wants, that only Y will say. Is X able to control Z or not? 100% yes. What you are computing is not voting power. What you are computing is effective ownership. Yes, sir. So sometimes if that effective ownership is coming below 50%, don't get panicked and all. It's still parent only, control is still there. Anyway, that nuisance is not there in some, but in some other question it is. Right. So if your effective holding is 60, other fellow's holding is 80 a moment. If Y books flow, sir, investment is appearing at what value? 980 they purchase. 980 is the cost for which company? Middle company. But for the topmost company, what will be the cost? 980, who spent? Y Limited spent. But X Limited is only 80% owner of Y Limited. So E 980 lo, X Limited related share is 80% only. Please do the math. That means the cost of investment in Z from Y Limited point of view is 980, but you are not consolidating Z into Y, no. You are consolidating Z directly into X. So X point of view, cost is not 980, their cost will be only 784 lakhs, 80% of the overall cost. Yes, sir. Why we have to identify this is goodwill computation. You will not take 980, you have to consider only 780. Then later on, if I tell you, link will go away. So here only I made two adjustments. Hereafter, what is there, sir? Y Limited ka net assets statement to prepare, identify post acquisition here and now. Similarly, Z Limited ka net asset statement to prepare. That also time adjustment on all you do. Unrealized profit is there, eliminate that. Work out the correct post acquisition profit, allocate it. But allocation will be done to whom now? X and N. The share of their effective holding 60/40 you have to do. Now coming to the main adjustment. Focus here. Goodwill capital reserve. You have to work out two goodwills or two capital reserves or one goodwill, one capital. Two companies are there. One is Y, one is Z. Y related goodwill capital reserve very easy. Z related goodwill capital reserve when you are computing, then you should be careful. Yes, TC you should not write 80 lakhs. Because 980 lakhs who invested? Y invested. But consolidation of Z is happening directly into X. X ki how much is the effective cost? 784. So you should take 784 lakhs only and compute the goodwill calculation. Yes, sir. So 784 you have to do. If some goodwill did not come, capital reserve came. Let it come. No. Here, beautiful adjustment. Sir, do you agree that goodwill capital reserve compilation is step whatever you are seeing now? That is a step where some accounts will die and two accounts will be created now. Which accounts are dying? Investment is dying. Subsidiary ka share capital is dying. Subsidiary ka pre-acquisition profits are dying. Who are getting created? NCI is getting created. Goodwill capital reserve also is getting created. Correct? Now, once what's the question? In the standalone balance sheet of Y Limited, investment is appearing at what value? 980. But now, goodwill step you consider how much? So entire 980 got killed. 784 got killed. 784 only got cancelled. Correct? How much is not cancelled? Remaining 196 is still alive. If you don't do anything now, a 196 will appear in the final consolidated balance sheet. You did not cancel 980, sir. You cancelled only 784. A 196 will shamelessly come up into the consolidated balance sheet. That is not wrong also in a way. But we cannot show investment in our own subsidiary while preparing consolidated. Imagine, sir, balance sheet heading. Consolidated balance sheet of X Limited and its subsidiaries Y Limited, Z Limited, and asset side I will write investment in Z Limited. Will it look good, sir, if I invest in myself? Correct, no? So what we will do is, instead of showing this on the asset side, the uncancelled, we'll go and present it as a reduction from the. Why should I hide it, sir? You have to hide it because it looks very bad if you show investment in yourself. Moreover, investment is not ours. Tell me, investment belongs to whom? One second, from the beginning. What is the cost of investment? 980. Who made that investment? Y and Z. Y 980 lo, topmost company X ka share is how much? 784. So X point of view, our entire group point of view investment is only 784. Our remaining 196 belongs to other remaining 20% shareholders in Y Limited. 20% shareholders in Y Limited is called as NCI in Y Limited. Investment belongs to that fellow actually. So instead of showing this investment on the face of consolidated balance sheet, you take and give it off to NCA. Reduction la jubichans. Just a presentation part. Clear? Here in this again, people what kind of confusion will come is, today minus it from NCA of Y Limited, NCA of Z Limited. Y Limited. Because who is the owner of this you see? Who is owner? Y Limited. 20% shareholders are the owner. Remaining 80% X Limited is only the owner. 784 already cancelled. 196 who is the owner? Y Limited. Small shareholders are the owner. The NCA of Y Limited you have to show it as a reduction. Still confusion is there. Add both the NCAs. The total NCA removed. Nobody will know what you are thinking. So that is the ultimate cover up. Even you have to work out two NCAs. Total NCAs from there you remove. Two NCAs are completed. I have to tell correctly, I removed it from here. But in case you are confused, total these two, from this you remove. The same answer. Hello. Key adjustments. Effective holding you have to calculate percentage terms. A percentage, what is your cost of investment you have to work out. For 3, whatever is uncancelled portion of investment that you have to show it as a reduction from the adjustments to the rest of the sum. In this story, the adjustment, what you have to do, all this. In holding, just like any other question with 3 changes. Effective point of view, all this you have given here, how to work out effective point. Goodwill problem, follow 2 adjustments. Don't consider the total investment. Parents' share of such investment only you have to consider. How to compute at 784 lakhs that I told you. And then the investment should be presented as reduction from first subsidiary. Very popular question, but it came not recently, quite some time back it has come. Same holding for the upcoming exams. It has been almost some 5 exams. Yes, chain holding has been tested. Same when they tested, no surprise. RTP clearly they told chain holding is not part of self. November 1st compulsory question of chain holding. People who already learned that also, after looking at RTP, why will they revise? Will not revise, no. At that time gone. Added marks apparently, but all cannot be there. In that paper, who is lucky is people who did not watch RTP, people who study on their own without gossiping and discussing everything. They are happy. Ignorance is bliss, so they will prepare chain holding. Very. So that's all about your subsidiary. We have to now discuss associate, and that will be very simple. Not that difficult, but this is how. Now, coming to investment in associates and joint ventures, the relationship of an associate will get created because of entity having significant influence. Basically is a power to participate in decision making process, whereas control is literally a power to take decisions, whereas significant influence is only a power to participate. Now, what the standard Ind AS 28 tells is, if you are having a voting power greater than or equal to 20%, then significant influence is deemed to exist. The other entity is your associate unless you prove otherwise. You prove that, sir, I'm having 25%, but whatever I say, wantedly those people are doing opposite of that. Never my idea is considered in decision making process. I'm always cornered. I'm 25. There are 3 other shareholders. They are also 25, 25, 25. But those 3 are friends and they don't like me, sir. Whenever I propose something, propose this, sir, wantedly they are doing against me. You prove like that, showing all the minutes of the meeting and all, then there is no significance. Otherwise, it is deemed that the other company is your associate. Similarly, when voting power is less than 20%, then there is no significant influence unless demonstrated otherwise. And moreover, when I say your voting power should be greater than or equal to 20%, but it should not exceed, because if it exceeds 50%, you will land into the zone of control. The other entity is not your associate, it will become your subsidiary, basic associate. Now, if it is an associate or if it is a joint venture, as we will discuss later on under Ind AS, then we have to apply equity method, which is described under Ind AS 28 for preparing consolidated balance. The consolidation procedure given under equity method is very easy and simple method. Unlike subsidiary consolidation, it is very small, very cute, very easy. Important also. See, whether it is associate or joint venture, we will not differentiate. For us, both are same only. For both of them, you apply equity method. Equity method is covered under AS 28. How to apply equity? I'll give an example. Carefully go on follow. X Limited bought 30% shares in A Limited on 1/4/20 for an amount here's two different pieces I'm taking. Balance sheet of A Limited. Who is A Limited? Our subsidiary or associate. Associate ka balance sheet, I am giving it on 2 dates. One is on the date of acquisition. One is the date of consolidation, the end of the year. When I entered, what is their position? By the end of the year, what is their position? 2 things. So share capital 10 lakhs, 10 lakhs. No change in this. Retained earnings 5 lakhs. Remaining assets and liabilities, you can fill whatever you want. Rating. So this is the balance sheet of your associate on the acquisition date and the consolidation date. Now how to apply equity? Step by step understand. What is the retained earnings of A Limited on the date of acquisition year? Acquisition date 5 lakhs. But by the end of the year it became 8 lakhs. That means that associate company has earned a profit of 30% after the date of 3 lakhs after the date of acquisition. So under my significant influence, associate earned a profit of 3 lakhs. Can I split now this profit into pre and post? No. It's very easy to split 8 lakhs into 2 parts. You have to do, that's all. But normally you can also prepare a statement of net assets associate. So how to prepare this? Just like how we did in the case of share capital. Share capital no change. Year ending also 10. Retained earnings. Those 5 lakhs. Current year they earned 3. Closing balance is this 3 lakhs is 100% is post acquisition. As this 15 lakhs basically net assets on the date of. But this is not subsidiary, no? Why should we compute? We will know one by one. Go compute goodwill oblique. Normally, goodwill you will compute only when there is a business combination. Business combination will be there only when you obtain control. In the control case, significant influence case. So ideally, we should not compute goodwill. The standard requires that you compulsorily compute for capital. Why we will see. So 2 cases I have taken. TC for your 30%. Case 1, how much did you pay? Case 2, paid 4. You should not literally apply the goodwill template what we learn in consolidation of subsidiary, because there you are parent, somebody else is NCA. In this you are only NCA. You should not write NCA 70%. You are only non-controlling interest. No. So presentation it will change. Matter same only. This will compare it with our share of fair value of net assets on the date of net assets on the date of acquisition. How much you know this? What is our share? 15 lakhs or 30%. $1,50,000 positive number. 50,000. The 1,50,000 is a case of bill. Second case, situation of a bargain purchase gain be identified as capital. Now, how will we bring this into balance sheet and one by one? The first step, everybody is there is the same stuff. Goodwill template presentation changed. Instead of writing NCA, I wrote our share of net assets directly. Normally, what do we write? 100% net assets. Raji NCA Raji. Instead of writing 100% net assets and NCA, directly wrote 30% net assets. Now, balance sheet of SFS. Their standalone or separate financial statements. Investment in A Limited. An account will appear. At what amount? Depending on what is your piece. That's one case. 4 lakhs is SFS. So CFS lo how will you carefully observe? It's a very, very interesting case. Consolidated balance sheet. As usual. Investment is anyway there. Bring that investment. Let's take first case, second case separately will add. So this will add your share of post acquisition. What is the post acquisition profit earned by the associate? In this, what is our share? We are 30% shareholder, no. Our share is how much? And 90,000 go and add it to the investment. If you add only to the investment, a balance sheet will not tally. This side also you add. So in your other equity, so you add an amount. That's all. Investment in brackets లో acutely including goodwill of a goodwill will sit inside the bracket, it will not come out. Why it will not come outside? Goodwill you can show only when you are having control. All assets, liabilities, when you are copying, goodwill also will come. Assets and liabilities I am copying. I am only showing my just adding post acquisition profits in associate to the investment and correspondingly to your profits. That's all. That's all is your equity method. Over, sir. Only this much. To get this effect, what is the entry M rating? Consolidated books, what is the entry M rating? Consolidated books rating investment in associate account debit 2. The profit from where did I copy? Associate. Associate ka which account? Retained earnings. Retained earnings came from where? PRL. So if you copy from PRL, you add it to your PRL. If you copy from their OCI, you add it to your OCI. If you copy directly something from their other equity, this is the core entry what you. Sir, all this is okay, but why are you calling this as equity method? Post acquisition profits, so your share you are going and adding it to the cost of investment. Why are we calling this as equity method? Simple, ma? Come back here. As on today, 31st March 2025, what is the net assets in Associate Limited? Net assets 5 lakhs minus 7 lakhs is how much? 18 lakhs, correct? Or can I also work out like this? 10 plus 8 also is 18 lakhs. We are shareholder in that company to the what extent? 30%. Equity 30%, you are only owner. Do the math. 18 lakhs into 30%. 5 lakh 40. 5 40. Plus at the time of entry, you paid how much extra consideration goodwill? 150. 540 plus 150. E690 basically represents proportionate share of net assets plus in this sum net assets is 18 lakhs into 30%. Net assets and equity equity share capital plus other equity net assets also. So that's why it's called as equity. When you say 18 lakhs, these assets and liabilities of. So somebody asks you, did you consolidate assets and liabilities of associate? And indirectly, yes. Every asset of associate, every liability of associate, 30% there in my balance. Not with the same names though, but with the name of plus whatever goodwill they paid. The equity. You understand, sir? It is very important logic. If you don't understand this logic, unrealized profit elimination entries you will not understand. When you apply equity method, a final number will represent your share of every asset, every liability in associate balance sheet plus your goodwill. A goodwill will not appear in the consolidated balance. The brackets so it will be there, feeling it will be there. If I ask you, sir, where is goodwill? Goodwill is included in the investment. 6 lakhs of goodwill is there. Separately it will not exist. Where it is there, sir? It is case 1. Case 1 is relatively simple. Case 2 also simple only, but one extra point you have to remember. The gain. Come to case. If case 2 I am preparing consolidated balance sheet, your investment in associate, you invested 4 lakhs only. Our share of post acquisition. How much is our share of post acquisition profit? Add that. How much are you having now? 4 lakh. Correct? Tell me, sir. How much is the net assets of associate as on today? 18 lakhs. 18 lakhs our share. 5 lakh 40. But our investment in consolidated balance sheet is appearing at whatever standard. For investment after applying equity method definitely represent proportionate share of net assets. It is not represent because associate net assets are 18 lakhs. 18 lakhs for 30% is 5 lakh 40. But how much am I getting? 490. Why are you getting only 490? Because at the time of investment only 4,50,000 net assets ki you paid a consideration of only 4 lakhs. There was a gain at the time of entry. That is the reason it is not getting reflected correctly. Standard says I don't care all that, adjust. So what is big deal? Adjust it. 50,000 add. From how much now? Balance sheet will not tally. In 90,000 I will add my retained earnings. If 50,000, since that is capital reserve, you add it directly into. You must ensure that this represents ESNA of I understand the two cases I took. Goodwill case, you need not do any special adjustment. Just add post-acquisition profits to your share. That's all. Whatever has to happen will naturally happen. If it is a capital reserve scenario, then whatever capital reserve bargain purchase gain you get here, again you should go and add it to the cost of the investment, create capital reserve, and this will be part of your. Our goal is to show our interest, the net assets of the associate, the face of the consolidated balance sheet. Are you understanding what I am trying to say? Now, in the material, sir, open this. A line you please add, no? One line got missed. Whatever I wrote is correct only, but just one line extra you can add. The goodwill case, you see what I wrote, goodwill is included in the carrying amount of the investment. Amortization of the goodwill is not permitted because a goodwill is not existing separately. A goodwill is part of the investment. Whereas capital reserve case, what happened is the investment lower cost you made. So the extra point if rate it says this capital reserve is to be shown as part of other equity by adding to carrying amount of. At this point it will be more clear. I already wrote capital reserve you have to show, but more clear. Capital reserve other equity lo you have to reflect. That capital reserve has to come, investment has to increase. Yes, could you update this? Right, sir. Now, come to this table. Go on the next page. There is a small table where entries are given. Try to understand that. So, very, very interesting case. The table is second column, whatever is there, that itself is a examination question. Long back came, recent past did not come, but it's a good question. Sir, one by one as transactions happen, SFS books lo what accounting entries we will write, CFS books lo what accounting entries we will write. Okay, first, I purchased investment in associate. SFS lo what will I write? Investment to bank. CFS books lo also you should write investment to bank only. If it is subsidiary, I will not write investment to bank. I will write assets to liabilities to NCA, balancing for goodwill to bank I will write. When is subsidiary investment? Is not subsidiary investment, is associate or joint venture. Equity method law also ultimately investment should appear. So the entry you will write is investment in associate account debit to bank even under consolidated books. Next, for applying equity method obviously applicable only in consolidated books. Now equity method la the ultimate goal is identify the post acquisition profit. Post acquisition profit who is making? Associate is making. Associate ka profits where can I find? There are some transactions PRL profit is recorded. Some profits are recorded in OCI. Equity related transactions ka profit is recorded directly in retained earnings. Imagine my associate has a subsidiary. My associate has a subsidiary. Our subsidiary lo my associate has got 100% shares. In that 100% shares they sold 20% shares. In the 20% they got a profit. But 20% shares when associate sells, associate is not losing control on its subsidiary. Therefore, whatever gain or loss it gets, that is directly adjusted in other equity. Sale of shares in subsidiary without loss of control. You should not go into PRL. Adjusted where? But from my point of view, investor point of view, even that profit is a post-acquisition profit. In that 30% also I will copy. I will add it to investment. Credit where? From wherever you copied, correspondingly in your books, same account. You copied profit from PRL, PRL you add. You copied profit from the revaluation surplus you add. You copied profit from their OCI, fair value gain on debt investments, add it to your OCI, like that. So next entry, sir. Coming to third entry. Associate declared dividend. If associate declared dividend, SFS or dividend income, bank account debit to dividend income will go to P&L. PFS law, this is a beautiful entry. You should not credit to P&L. Credit this directly to investment in bank to investment. Why bank to? Thought process. Watch this. Key particular sum, what we just saw. How much is the post-acquisition profit they earned? 3 lakhs. The 3 lakhs, our share is how much? 90,000. What did you do with that 90,000? You added it to the cost of the investment and correspondingly put that in your PRL also. Did they declare dividend or no? Even before they declared anything, they earned, you happily recorded in your PRL. Subsequently, imagine, associate next day morning they got up and they declared 90,000 rupees dividend to you. Bank account debit. Tell me, sir, will I again credit that to P&L account? Huh? When they earned profit, entire profit, I already put it in my P&L account to the extent of my share. If they declare dividend out of that profit, will I again put it in P&L account? Huh? No. What should I do? Our profit, why did you add it to investment? Why you added to investment? I initially invested X amount. You performed very well. X now became X plus 90,000. Now 90,000 again you paid back to me in cash. So what will happen to my investment? In investment will come to X. So when you receive the dividend, it is a recovery of your investment. So you will remove. Simple, sir. You invested 10 lakh rupees, you floated a branch. A branch of business is happening. By the end of the year, branch made a profit of 50,000. But you invested how much? 10 lakhs. So your 10 lakhs now became how much? 10 lakh 50,000. Out of the 50,000, 20,000 you took money, withdraw. What is the remaining net assets? 10 lakh 20,000, 10 lakh 30,000 after removing 20,000 rupees. I invested 6. That fellow earned a profit of 90. So my investment worth is 690. If that fellow pays you any amount, then your investment value has to be, there will be bank account debit to in which books? Consolidated. Here. You remember, subsidiary books law, intercompany debtors, intercompany creditors will cancel. No intercompany elimination should be done with investor or associate. I sold goods to you. You are my debtor. I am your creditor. You should not cancel that. Intercompany owings should not be eliminated. Till date never came. Number 24. Old questions. Old question. Subsidiary is our own fellow. Associate is not our boy. Not cancel intercompany receivables. Or how will you cancel? My balance sheet, your balance sheet, if you are merging means I can cancel. Associate ka balance sheet is getting merged into parent company balance sheet. No. No. Investment is still retained. Asal that fellow's books or creditor debtor is not coming into my books. How will I cancel? Impossible. Don't cancel it. Important point. Recent example also it came. For intercompany owings we should not remove. Okay. What about unrealized profit? Not completely. Only to the extent of our share. Investors' share work. Unrealized profit has to be. Is also very, very interesting. 2 examples and we are done with associate. Just watch this patiently because ultimately they gave it correctly only, but explanation is very far-fetched. This is easy. Focus here. Sir, is X Limited. In my balance sheet, I have investment in A Limited. 30%. Below is A Limited. Between this X and A, transactions happen. Transaction is X Limited sold goods costing to A Limited at. So how much is the profit charged by X to A? 50 rupees. The profit will be there in your, since they purchase the stock, their inventory, they recorded it. 100% correct accounting, both of them. But consolidation point of view, one small adjustment. Tell me one thing. Can I sell goods to myself and recognize profit? Can I sell goods to myself and recognize profit? Cannot. In case I did, I have to remove it, correct? Same time. Can I sell goods to outsiders and recognize profit? In this transaction, total unrealized profit if you see, but A Limited lo, I am owner only to the extent of 30%. I am not owner. Outsiders are owners to the extent of. What you should do, 30% our share, 70% outsider share. The outsider share of profit, I don't have a problem. That can stay. This needs to. Because A Limited share capital, X Limited also is owner to the extent of. A transaction happens, it's like I am selling goods to myself only. Our profit 30% is a fake profit, 70% is genuine profit. 70% I don't have a problem, 30% I have a problem. You have to eliminate unrealized profit only to the extent of 15 rupees. So the entire URP should not eliminate. Our share of URP. Fantastic sir, 15 rupees we will eliminate. But from where should I remove this profit? Tell me, who sold goods to who? X Limited sold goods to A Limited. So this profit is there in whose books? Whose P&L? X Limited books. Happily remove. Happily remove. Fantastic. Beautiful. Credit what? Stock. Stock is there in whose books? A Limited books. Will that stock come into our books? Will it come? Will not come. The full consolidation, their assets, their liabilities will come into subsidiary, it will come. Associate, will it come? Our stock will never come into your books directly. But indirectly, our stock is there in your balance sheet. How? On this investment, when I apply equity method, what will happen? This will start representing 30% of net assets of, correct? So, 150 the 30%. 150 the 30% is how much? 45. 45 stock is indirectly represented in my point is this. To 150 stock, 50 rupees profit is there. When I apply equity method, stock 30% is indirectly reflected in my investment. 45. 150 50 rupees profit if it is there, 45 how much profit is there? Go and remove this from your investment. Questions are there. FRS will never came in. Will come. What is already asked, how many times will you study, sir? Going to come. You understand? Unrealized profit entry without touching stock, we are writing entry. Definitely important, there is no doubt in that. Reverse case. Reverse case, X Limited, A Limited. Investment in 30% shares of A Limited. This time who sold to who? A Limited sold goods costing 100 to X Limited at. This time profit is there in whose books? associate books lo profit. In our books, what is there? Before we discuss anything, general common sense. Sir, when we buy anything in the market, remote, water bottle, mic, mobile phone, whatever we buy and whatever I pay, that is cost only. Whatever cost I am paying, that outsider ka profit is there. Seller ka profit will become my cost. The outsider ka profit will definitely be our cost. If 50 rupees profit, who charged? A Limited charge. A Limited lo who are owner? I am only owner, but to the extent of 50%. But to the extent of 70%, outsiders are owner. Outsider ka profit can be forming part of my cost. That is correct only. I need not eliminate that. But the profit which I charge it to myself, no. That you should. So if 50 la, our share 30%. What is that? In 15 you have to eliminate from your stock. So, E 150 stock you have to eliminate how much? 30 paisa, the outsider ka profit, I paid money, pakka cost, don't touch 35. 15 ka problem. So, half entry is done now. Debit where? Tell me correctly. You can go after. Where should I do it? Simple question. Whose P&L account of profit is there? Who sold goods? Associate sold goods. Profit is there in the books of A Limited. But consolidation equity method is happening in whose books? X Limited. Consolidation it's happening. Profit from where should I remove? Here. Why? Who sold goods? A Limited. Entire equity method accounting is happening where? X Limited books. But profit is there in whose books? A Limited book. Where will you debit this? A Limited P&L. Possible. Debit it to consolidated. Sir, profit is there in that fellow's books. How can you debit your P&L account? Profit will be there in his books. Okay. Won't you apply equity method? When you apply equity method, what will happen? In this 30%, won't you add here? Won't you correspondingly add to your P&L account? Equity method means what, sir? That fellow's profit 30% you will copy, no? When you copy, it will come into your P&L account, no? Remove it. A 50, how much did you copy? 30%, which is how much? Came, no? Remove it now. You understand, sir? Profit will be there in associate books, but when you apply equity method, a profit will come into your books. Come into your books. Not entire profit, unrealized profit. Particular diagram is only for unrealized profit. So, when somebody talks about eliminating unrealized profit in equity method, blindly remember like this. Easiest way. First debit PRL. Who sold goods to is irrelevant. Ultimately, equity method is happening in parent books, investor books, investor P&L. You have to debit. No option. Here. Now. If goods are there with investor company only, then credit stock. If goods are there with associate, our goods or stock of associate ka shadow is appearing in our books in the name of investment. One is upstream transaction, the other one is downstream. Upstream transaction, associate sold goods to investor. As goods are there in my books, I will remove it. If I sold goods to associate, goods are there in associate books. I cannot remove that stock now. A stock is correspondingly reflected in my investment. Credit the investment. This story for what? Eliminating unrealized profit. And remember, unrealized profit should not be eliminated completely like in subsidiary case, only to the extent of our share. And do not touch intercompany owings. Example of the traps are pakka question, it will be there. Last November asked first time question. Clearly intercompany debtors, creditors see here. Gave intercompany debtors and creditors. You should not touch that. Those are traps. Be careful with this kind of adjustment. The questions may not have tested so much in the past, but slowly things are changing, sir. Concepts, if you learn properly, exam will be safe. See, these are IFRS questions, sir. Parent, subsidiary, associate. The column. In this, due to intercompany sales, P books showed 50,000 and 20,000 as owings to S and A respectively. Subsidiary related intercompany owings you have to cancel. Associate related intercompany owings don't touch. Happen. Wantedly they are giving it. The IFRS question. May 24 examination. 16 marks. Trade payable of H Limited includes 25,000 payable to A Limited. That's how they pick questions. Be careful, sir. Concept flow lag should not be this. Not by heart formats of already available questions and all. That is very wrong way of learning it. Please be more serious. Okay, guys. That is that with our associate. We'll wind up for today. Tomorrow we'll take up with the joint arrangements, which will get over in half an hour. We'll take up small standards, or we'll do 1 month. So guys, now that subsidiary consolidation, associate consolidation, 2 consolidations are over. Now the next chapter is joint arrangements. This standard joint arrangements does not have very deep accounting, because the joint arrangements are categorized into 2 types. One is joint operation, the other one is joint venture. In case you establish that the joint arrangement is in the nature of a joint venture, then the accounting for joint venture will be similar to accounting for associate. That means the equity method what we learn for associate, as it is 100% is applicable when joint arrangement is classified as a joint venture. But if it is not classified as joint venture, if it is classified as joint operation, then equity method you should not apply. You will apply some other method called as proportionate consolidation method. That proportionate consolidation method, how to apply, that is given in Ind AS 111 only. Now, on a conceptual note, if you understand, 1 second, sir. Yeah. If there has to be a joint arrangement, this joint arrangement is basically a contract, and any contract for that matter, for entering into any contract, at least how many parties are required? Minimum 2 parties are required. So, if 2 parties enter into a contract to jointly control, then this arrangement is referred as joint arrangement. So to be qualifying as joint arrangement, important aspect is this term called as joint control. So for example, there is an entity X Limited. In X Limited, there are 3 shareholders. Means many shareholders are there, but A, B, C are 3 shareholders. These 3 are holding shares in X Limited. If there needs to be a joint arrangement between A, B, C, prima facie, one contract these people have to enter. What contract they should enter is, any decision in X Limited, we all 3 should take concurrently. That means, if there is a resolution up for a decision, A, B, C will vote in the same fashion. They all will either oppose the resolution or they will approve the resolution. Okay, so A, B, C, between them, they will first reach a consensus, and a single way voting is done by A, B and C. That means there is a contract. A, B, C also have identified or understood that we all 3 will vote in the same fashion. That is fine. So this is a contract. In this contract, unanimous consent provision is also mentioned. But if this has to become a joint arrangement, important aspect is these 3 fellows put together should have control also. Contract is there, okay, but control also should be there. Control should be there collectively at least. I mean to say, agreement is there, parties are there, all this is fine. I ask AA, how many shares are you having? A is telling me I'm having 10% shares, B having 3% shares, C having 2% shares. Even if they write a big contract also, can these three people collectively control X Limited? No, because all three put together they are having only 1/5. We need more than 50% voting power. That is not there with ABC. So this is a case of an agreement, but here control is missing. So joint control case is not possible here. So if there has to be joint control, there should be a contractual arrangement between two or more parties. That is one thing. Plus, these two or more parties should have control on the arrangement. If control it is not there, how can I call it as joint control? Combinedly, control should be there. And the parties to the arrangement should agree to unanimously take decisions. For example, A and B like the arrangement. On some particular decision, A and B approved. C did not like it. Ideally, the vote should not be passed on. Unanimous consent means all the three parties should agree to do something. Then only matter will be done. It's like a coalition government. There are 4 or 5 parties who joined together and formed the government. Namesake one prime minister will announce. But can he take unilateral decisions? No. All the parties should concur. Likewise. So, an important feature of joint arrangement is something called as unanimous consent. The consent of all the parties is required. Let me put another numbers for you. A, B, C, 3 parties are there. A is holding 30%, B is holding 40%, C is holding 20%. If you observe, overall these 3 fellows put together are holding 90% in a company called X Limited. The remaining 10% are held by some people else. Now, between ABC, they entered into a contract. Under this contract, they agreed that for any decisions in X Limited, we all 3 should arrive at a unanimous consent and then only we will vote. Fine. It's a classic case of a joint arrangement and joint control also is existing. But to pass anything in X Limited, voting power more than 50% is sufficient. Voting power more than 50% is sufficient. Now, there is a decision that is to be taken. A approved for it. B also approved for it. C did not approve for it. When C did not approve for it, what will happen? What will happen? Now what will happen is something you have to see. Because for getting a matter passed in X Limited, how much voting power is required? More than 50%. And more than 50% A and B put together only are having, correct? This particular joint arrangement is deemed to exist only if and only if A and B should not go ahead with the decision because C did not agree. A and B should not go. If A and B say that we are anyway having majority, you are a small kid, go and play outside, we will take decisions inside, then there is no joint arrangement between A, B, C. Next you have to see whether there is a joint arrangement between only A and B. A, B, C ki joint arrangement, if it should be there, all the parties ka unanimous consent is a must. If unanimous consent is missing, there is no joint arrangement. Am I clear here? Next. Look at this. A is having 40, B is having 20%, C is also having 20% in a company X Limited. In this X Limited, to take any decision, voting power more than 50% is required to make a decision. Now, ideal rule is only if unanimous consent is there, joint arrangement is deemed to exist. There is one exception for this. What is that exception is? How many parties can approve resolution now? A plus B plus C, all 3 can agree and resolution will be passed. A plus B also can approve it. A plus C also can approve it. That means if all the 3 unanimous consent is required, then it's a classic case of joint arrangement. There is no doubt in that. But if you say that A plus B also is okay, even if C is not agreeing also, we don't mind, we will proceed ahead. Or if B is not agreeing, A and C will proceed ahead, then there is no joint arrangement, sir. There is no joint arrangement. Unless in the contractual arrangement what these people have entered, no, clearly they wrote that
there are some matters which are financial in nature, like how to raise money, should we issue equity shares, should we raise bonds, or where to invest surplus money. These kind of financing decisions, A plus B ka approval is enough. C will not play any role in decision making relating to financial matters. Whereas something relating to operating activities, from where to buy goods, where to sell goods, what is our marketing strategy, how to beat the competition, what should be our sales price, whom to hire, whom to fire, these kind of decisions, A plus C the consent is enough. Like that, it is enough and they wrote in the original contract itself. You know, in this case, since you people are already prepared to take decisions in the contract itself, even without the help of C in financial matters, even without the approval of B in operating matters, the standard says a joint arrangement is in existence. Indirectly, you know what? If somebody writes this in their contract itself, and the contract who signs? A also signs, B also signs, C also agreed. No, you know what is the meaning of that? C is indirectly giving approval for all the activities that are approved by A and B, and B is giving approval for all the decisions that are going to be taken in future by A and C. Are you understanding, sir? That means a set of the parties themselves are also capable of taking decisions. Here unanimous consent is not required because E fact is already mentioned and identified where? In the contract itself. This is one exception where without unanimous consent there could be a joint arrangement. Am I clear here, sir? Right. Next, coming to 2 or 3 examples and then we'll go to the accounting. Accounting is simple, but the story, the theory part is extremely important in this standard. Okay. Now, let's say there is A and Co. Sorry, there is A Limited one company, B Limited another company. Both these companies are operating in the adjacent premises. In the area where these people are running their factory, there is a power cut during the day for a period of 4 hours. So their operations and all are getting affected. So what they did, they purchased a power backup. Diesel generator set they purchased. Anyway, per day we needed to use only for 4 hours now. So why to buy individually one asset? So what they did is total cost 20 lakhs. A invested half, B invested half. They purchased an asset. E asset, come maintenance, both of them will take care. For 1 month, all fuel requirement of the generator, A will incur, another month B will incur. Or whatever is incurred, they'll split among themselves. So this is one example of a joint arrangement. All the decisions relating to purchase, maintenance, that is usage of the asset is taken by A and B. Between A and B there is a contract. This is a simpleton example of a joint arrangement. If a little higher level look, if you go, I am a petroleum manufacturing company, petroleum refining company. How will you get petrol? From crude oil. If crude oil from wherever we import from other countries and all, from there it will come in a ship. From ship, how will it come to my factory? Through pipelines. A pipeline, I am HP company, there is Bharat Petroleum, there is some other Reliance Petroleum. Do you think we all will sit and lay down our own separate pipelines? No. What will happen? There will be a single pipeline. A pipeline ka cost is shared by all the players. A pipeline is an asset because that is not a revenue expenditure, no, capital expenditure. Now who is going to incur that? All the players will combinedly incur that. Maintenance, all of them will take care. Benefit, all of them will use it. So at a higher level, these are all joint arrangements. Let's see another example. AB and Co is one firm. XY and Co is another firm. There is PQR Limited, which is a MNC company. Actually, PQR Limited ki AB and Co is the auditor from the last 20 years. Now, PQR Limited wants to go global, raising funds in the form of GDRs and all. So, if you want to raise money abroad and all, you have to furnish your financial statements. Our financial statements should be certified by the auditor, obviously audited financial statements. Who will recognize AB and Co outside India? Nobody. So normal medium sized firm in India, people here, it's a decent firm, but outside India, nobody knows. For these purposes, what people do, they will hire a big four. So they will go for Deloitte, KPMG, EY, Pricewaterhouse, these kind of firms they will hire, and they want that particular branded signature on their financial statement, so that public will put more trust on our financial statements when we go abroad for raising funds. But I cannot replace my existing auditor completely and hire a new auditor now, because auditor's replacement is a very dangerous decision. Post qualification, you will understand it more clear. If somebody removes you as an auditor, how revenges can be taken? There are different ways. Anyway, so what PQR Limited did is, it hired both of them. So these people first will enter into a small arrangement of joint audit. In joint audit, what will happen? Both the firms will decide what are the various areas which you have to do audit. What is your areas? What are my areas? How are you going to do broadly? How are you going to get a comfort on these areas for expressing your opinion? What work I am going to do? If you both are on the same page, then work division will happen. My staff I will bring, your staff you will bring. Some areas audit you will do, outside branches and all we will take care. Ultimately, we'll compile all the information. Last 10 days, we'll sit in our office and we'll finalize the audit report. Right? Whatever audit fees comes, how much will go to AB, how much will go to XY, they will split it. Do you understand, sir? Here, also it's a kind of a joint work. For carrying out an operation, two entities are coming together, work is done, entities will move away. They will do their own business independently. Do you understand? This is another example. Look at another one. A, B, C, three fellows are there. What they did is, they purchased a land and constructed 3 floors. They constructed it in such a way that the first floor belongs to A, second floor belongs to B, third floor belongs to C. They constructed, they together purchased the land, they together incurred the construction cost, and then they have shared the property. First floor mine, second floor is, third floor, third fellow, like that. Now, whoever comes into this building for taking rent of first floor, entire rental income will go to whom? A. If there is a fire accident in third floor, who will face that loss? C. If second floor is not occupied at all, who will face that risk? B. That means, even though these people have jointly incurred costs, jointly own the property and all, the right to the assets and the right to liabilities are together shared. Each party has got their own share of assets, their own share of liabilities. This kind of thing in the standard, it definitely joint arrangement, but since the parties are interested in their share of assets and their share of liabilities, the standard says this kind of joint arrangement is to be treated as joint operation. You are doing together, but you are interested only in your portion of business, he is interested only in his portion of business. These are called as joint operations, where parties are interested in their own share of assets and own share of liabilities and not the overall net assets. This is joint operation. In this story, let's slightly change, see how it looks. A, B, C. Same building story only. Three floors building, constructed, all this is okay. But A, B and C did not construct the building on their own name. First, what they did, they pooled money, they formed a company called ABC Limited. In ABC Limited, A, B, C are partners, and ABC Limited constructed this building. And who is ABC now? They are shareholders in ABC Limited. And the building belongs to whom now? Company. Building does not belong to the shareholders. Assets of the company belongs to shareholders. No. Assets belong to the company. He only has a ownership right in that, correct? Now, tell me, sir. The third floor low fire accident happened. Earlier, C was crying, A and B were happy inside. Even though they are also acting sad, inside they are happy. Top city view కావాలంటే. So they are feeling happy. Now you see, now third floor of fire accident, a short circuit happened. Only C will cry. No, all three will cry. B, second floor is not going on rent. Top floor lo gym fellow came, ground floor lo supermarket came. Middle floor nobody is coming. Only B will cry. No, all three are crying. First floor we hired it to a bank. SBI came, 20 years tenant, solid rental income. Only A is happy. No, all three are happy. Why? Because the building is not shared among the parties. The building belongs to the company, the structured entity, and these parties are not interested in the individual assets and individual liabilities. They are interested in the net assets of the entity. There is a difference between I becoming interested in my assets and my liabilities versus I am interested in the net assets of the entire entity. When you say I am interested in the net assets of the entire entity, you know what does it mean? If at all that entity comes into liquidation, all the assets are sold, with that all the liabilities are paid, whatever left, whatever is remaining, if at all something is left, that belongs to all the three parties. I am interested in the equity of the business. That is a case of joint venture. Conceptually, if you understand, accounting is very simple. Joint operation, parties are interested in the individual assets, individual liabilities. Whereas if it is to be a joint venture, the parties should be interested in the net assets of the business. Am I clear here? Now, read the definition, sir. Fifth point, please. Joint operation can be further classified as joint arrangement can be further classified as joint operation or joint venture. In a joint operation, the parties have right to assets, obligation towards liabilities of the arrangement. The parties are now called as joint operators. Since the arrangement is described as operation, parties are called as operators. In a joint venture, the parties have right on the net assets of the arrangement. These fellows are not interested in the individual assets, individual liabilities. Overall entity ka net assets, so they are interested. So they want the business to grow. The parties are called as joint venturers. How to identify a JO or JV? This is a very, very important stuff, sir. Last 4 RTP, MTPs. Every RTP, every MTP, every alternative, almost some 4 or 5 questions came on this model. Exam one also did not come. Highly due. If you have to answer that, all you should know is the chart. 5 marks or 6 marks it can come, aram se you can score. But the chart should be there in your mind. Easy only. First and foremost question, sir. If you first establish that there are parties, between parties contractual arrangement is there, E parties are having joint control or something, joint arrangement is there. First you have to get clarity there. Okay, joint arrangement is there. Now whether it is a JO or JVA, that's the next question. For that, the first thing you have to check is whether these people formed a separate structured entity or not. A, B, C together want to construct a property and give it on commercial rent and enjoy the rental income. Building construction, did they do it on their own names? Did they create a separate entity? First question is that. If the answer is yes, sir, no, they did not create any separate entity. If you tell me that no, there is no separate entity created, Atam, over, you are a joint operation. The answer gets very simple for JO. So if there is no separate entity created, you are directly a joint operation. No, sir, we created an entity. Sir, entity means legal entity. It could be company, partnership firm, some kind of LLP, any kind of some structured entity is created. Then I am JV, yes, sir, no. Then further considerations apply. First question is separate entity created or not. If you say no, you are straight away joint operation. If you say yes, I created an entity, then I will go and check further. Now what you are going to check further, what is there in this chart completely? Listen, some form of entities will permit the parties to have assets and liabilities on their own name. Example, partnership firm. Partnership firm is a legally structured entity, agreed. But tell me, can partnership firm have assets and liabilities on its own name? No. Partnership firm who assets and liabilities will be there on the name of the partners directly, correct? No? That means even though we created a legal entity called partnership firm and all, first floor is registered on the name of A, second floor is registered on the name of B, third floor is registered on the name of C. Is parties having direct interest in ownership of their share of assets or not? Even though structured entity is there, this fellow is still interested in his share of assets and his share of liabilities. So even though legal structured entity is there, you are still classified as a joint operation. When you are interested in individual assets, individual liabilities, we call it as a joint operation. So that is the first question. Read the first boxes, sir. Legal form of the entity you have to check. What you have to check? Does the legal form provide the parties right to assets and obligation to liabilities? If you say yes, game over. You are a joint operation. Clear, clear? Come to second one. Second one, what I will see is, chalo, you did not form a partnership firm, you created a proper company or you created a limited liability partnership, which can also be as good as a private company. So, first case passed. Second case, you should go and see the contractual arrangement between the parties. Sometimes what will happen is, what these three people did is, they formed a company. A company is owning this building. A building ka benefits will come to the company, and from the company, is shareholders ka wealth also will increase. But between A, B, C, one contract is there. In this contract, they very clearly wrote that first floor belongs to A, second floor belongs to B, third floor belongs to C. Sir, how is it possible, sir? Asset is registered on the name of the company, no? Legally, asset is registered on the name of the company. But between themselves, they are going to settle in cash in such a way that the total income and total expenses relating to first floor should come only to A. Second floor ka incomes and expenses should be borne only by B. Third floor ka incomes and expenses will be borne only by C. Legally not possible because of the company. Company law, shareholder cannot have a direct ownership on the asset. So what these people did cheating outside. Legally not possible. No, between me and you, we can write any arrangement. In the arrangement we wrote, whatever dividend comes, first we will receive. Later on, between us sharing. First floor ka total income is mine. Third floor is C. Second floor is B. That means, even though legal form does not permit share of individual assets and individual liabilities, contractual arrangement of these buggers wrote off. That first floor belongs to me, third floor belongs to you, like that. Then also it becomes a joint operation. See the case, terms of contractual. Sir, your question is not going to change. Your question is always same. Are the parties having right to assets and obligation to liabilities? First, is a legal form permitting it? No, yes sir, joint operation. If it is no, then I will see, did you write anything in the contract like that? No sir, in the contract also I did not write anything like that. Chalo, then we will come to the last case. Last case is X, Y and Z invested money, created, okay, X, Y, Z Limited is very obvious, let me put some other name, A Limited. A Limited is doing manufacturing activity. In this, output will come. What is output? Whatever goods they are manufacturing. Ideally, after manufacturing, what will happen to that goods? The goods should be sold. The standard what it asks is, the output is it sold to outsiders or the output is again sold back to the parties only. That is the question I am asking. Is the output generated by the entity what you created? Output is it sold in the market like any other company, or output again you people are only buying? That is the question. Sir, what is the purpose of this question? Imagine, sir, who formed A Limited? XYZ. That means, who gave money to A Limited to buy raw material? X Limited. So, who is overseeing the entire management of A Limited? XYZ only. Output, imagine sir, if that output also is to be sold only to X, Y and Z, you know what is happening? X, Y and Z are sitting there and create a dummy entity where they will manipulate A Limited in such a way that A Limited ka profit or loss is in the hands of XYZ. No. Why? Cost I only incurred. Selling price who will decide? XYZ only. Why? Because they themselves are going to buy. Artificially what is happening? X, Y and Z are creating a dummy entity in such a way that a dummy entity, whether it will incur profit or loss or break even, all the decision will be there only in the hands of XYZ. So tell me sir, is it genuine entity or artificially fake fraud entity you are creating? If it was a genuine entity, you know how the situation would have been? Whatever output A Limited is manufacturing, that output could be sold to anybody in the market. Just like any other company, competitive pricing, you should have sold it in the market. But if you yourself are buying that goods again, that means what sir? The revenue, the cost, the profit of A Limited. Can I trust that now? Investor, ultimate customer, both are same. Do you think you will believe that company now? Who is buying goods? Namesake A Limited, but money belongs to XYZ. So A Limited is ultimately selling goods only to XYZ only. So tell me, is A Limited having any independent standing on its own? Does not have any independent standing on its own. So this is one thing they'll ask. Second question they're asking is, if A Limited is raising any borrowings and all in the market, our borrowing repayment capability is A Limited having. A Limited, when will it have repayment capability? When A Limited is making earnings on its own, with that money, if A Limited is going to repay the loans and all, we'll say that okay, A Limited independently is capable of managing its own funds. But no sir, A Limited cannot repay. If A Limited has to repay, first X, Y and Z has to pump in money into A Limited. Then only A Limited can repay. If you tell me that kind of thing, again what is happening? This created entity does not have any worthful standing on its own. I cannot classify it as joint venture. So joint venture status, if you want to get, you must pass the last criteria also. Other facts and circumstances, so what you will check is the arrangement designed in a manner that its activities primarily aim in providing the output to the parties, and the entity depends on the parties for settlement of its liabilities on continuous basis. Indirectly, sir, see, they won't write anything directly, indirectly understand. Is the entity having an independent status in operating its business? The 2 points ka ultimate question is this: are you having independent worthful status on your own? Yes or no? That's the question. If you say yes sir, output is sold to parties only. Liabilities, if I have to pay, I have to beg money from my parties only. If that is the case, then you become a joint operation. No sir, nothing like that. Output I am selling to outsiders, loan I am raising on my own, I am repaying the loan on my own. In that case, you become a joint venture. See, it looks lengthy, but ultimately it's only one line. Are the parties interested in the net assets of the entity, or are the parties interested in the individual assets and individual liabilities? If the parties are interested in the individual assets, individual liabilities, it becomes a joint operation. If parties are interested in the net assets, it becomes a joint venture. Now, how will we establish that? First question, is there a separate structured entity? No sir. Congrats, you are a JO. No sir, separate entity we created, I am JV, sir. No. You have to pass 3 tests now. Further evaluation required. Further evaluation, first question. What is the legal form of the entity you created? You created entity as proprietor firm, partnership firm, trust, society, LLP, limited company. What is this? I want to know. And does that legal form permit the partners or the parties to have assets and liabilities rights individually? If it is permitting like that, over, you are a JO. No sir, I formed company only. Good. Next question. Between you people, you wrote a contractual arrangement. In that arrangement, did you talk anything about sharing assets and liabilities of the entity? If the answer is yes, you are a joint operation. Third, no sir, we did not write anything like that. Then come to next level. Other facts and circumstances. Other facts and circumstances, so what you have to ask, is the entity ka output sold to outsiders or again sold it back to the parties. Plus, is the entity created having the capability to repay its own debt obligations or not? If you say no sir, output is sold to outsiders, I am capable of repaying my own debt obligation, then only you will become a joint venture. Otherwise, you are a joint operation. Clear sir? The entire chart you have to properly remember. On these questions are there. The highly important. Accounting part very cheap. Look at this. Joint arrangements, two types, JO, JV. If it is JV, in venturers books, you will prepare SFS also, CFS also. SFS you will simply show investment in joint venture in accordance with a separate standard called as Ind AS 27. 2 line standard later on we will cover. If it is CFS, here also we will show investment in joint venture, but after applying equity method as discussed in which standard? Ind AS 28. Sir, if it is joint venture, why should I apply equity method? That answer is very easy to understand. When will you classify something as joint venture? Only when I am interested in the net assets of that entity. And after applying equity method, what is happening to your investment? What is happening to your investment after applying equity method? Previous class discussion was that only after you apply your equity method, your investment will start representing proportionate share of net assets of the other entity. Proportionate share of net assets is what, sir? The equity only, no. And my interest is in what? Assets and liabilities are net assets. Since my interest is in net assets, investment also is appearing in the balance sheet at net assets of my investment. I invested in A Limited ka net assets, so my share will appear as an asset in my balance sheet with the name of investment in A Limited. Clear? Come here. If it is joint operation, then the standard says go and apply proportionate consolidation method. What does it mean? Suppose out of in the arrangement what you formed, whatever is your share of assets, whatever is your share of liabilities, whatever is your share of income, whatever is your share of expense, go and record that. That's it. That means when you prepare your balance sheet, you will have your assets plus our share of assets in joint operation. That also you will add. Similarly, you will have your own liabilities. To that you will add our share of liabilities in joint operation. Means in the balance sheet, whatever investment you have in that firm or that company, our investment disappears. Our investment place of what is coming? Assets and liabilities of that company are coming into your books. It is just like the normal subsidiary consolidation what you do. Only thing is, you will not do full consolidation, you will do proportionate consolidation. Meaning, I have 50% shares in a company. Even though that is a company, that is still identified as JO only. Since it is identified as JO, we have to apply which method? Proportionate consolidation method. Proportionate consolidation method, how to do? How did you do subsidiary consolidation? Same way. Only thing is, don't recognize NCA. Without recognizing NCA, rest of the procedure is same. So first of all, think why NCA came in subsidiary. Even though I am a 70% owner, I still consolidated 100% assets, 100% liabilities. Correct? Because I have control on that. So even though not the owner, still I copied. No, that is the reason I disclosed NCA. But here I will not copy 100%. I am owner to the extent of 60. I will copy only 60% assets and 60% liabilities. You tell me, sir, NCA will come or no? NCA will not come. But goodwill will come. Goodwill will come. So this is proportionate consolidation method ka story, sir. So, sir, why are you copying individual assets, individual liabilities of the joint operation? Because you are interested in that. Joint operation, the party is interested in their share of assets, their share of liabilities. So your accounting methodology is also given in such a way that after consolidation, whatever you are interested, no, they will come into your balance sheet. Whereas in joint venture, I'm not interested in individual assets and liabilities. I'm interested in the overall business and the net assets of the business. Therefore, in your equity method, a net assets ka shadow is appearing on your investment. Depending on what you are looking, accordingly accounting is happening. So this is the entire story of joint arrangements. On this, big practical questions and all are not there. Why they are not there is, mainly they have to ask you equity method, sir, and equity method related questions are already there in associate. So the same equity method is applicable here. But there are some theory questions and all where they'll give you some story and you have to identify whether it is a JO or JV, that kind of thing. So that's all for this standard. Okay, coming to Ind AS 27. This standard is called as separate financial statements. Separate financial statements, who will prepare is an entity which is having investment in subsidiary, associate or joint venture. This fellow has to do consolidated financial statements. Without doing consolidation, on its own standalone financial statements also they have to prepare. Such standalone financial statements are called as separate financial statements. A separate financial statements, a few principles ka guidance is given under Ind AS 27. Now in this very important point is, suppose I am an exempted company, I don't have subsidiary, I don't have associate, I don't have joint venture, I am only one company exempted. You should not, when I prepare my financial statements, you should not describe this as separate financial statements. If you describe this as separate financial statements or standalone financial statements, you are indirectly giving a hint that apart from this I have something else also. Do you understand, sir? That's why you should not use the term SFS anywhere unless you are having a subsidiary, unless you are preparing consolidated financial statements, you should not be using anything called as SFS term. So Ind AS 27 apply avalante prima facie subsidiary, associate or joint venture must be there. Clear, sir? Is standard importantly only one point is there, sir. That is, in your own SFS, separate financial statements, you have investment in subsidiary, investment in associate, investment in joint venture. These are investment in equities. Investment in equities ideally should go and apply Ind AS 109. But Ind AS 109 financial instrument standard says that investment in equity of subsidiary, associate, joint venture is scoped out. 109 does not cover that. So then who will cover? What the standard will cover? So the standard of what is there? The standard of choice is there. As a parent company, as an investor entity or as a venturer, you have a choice to carry your investment either at cost or fair value. So fair value means which one, sir? Both fair values, either FVTPL or FVTOC. So total for investment in equity of subsidiary, associate, joint venture, I have three choices now. Cost, FVTPL, FVTOC. Three choices are there, sir. Sir, I am having three subsidiaries, four associates, two joint ventures. Can I make random choice of one cost, one FVTPL, one FVTOC? No. The choice category wise you have to do. Just like class of assets concept in PP. All plant and machinery, either cost model or revaluation model. Like that, you have five subsidiaries. All five subsidiaries should either follow cost or fair value. Again, you will get a choice when you come to associate. Again, choice when you come to joint venture. Each category ki uniform methodology must be adopted. Clear? Next, another important aspect that is given under Ind AS 27 is any dividend you receive from subsidiary, associate, joint venture, or dividend happily, royally will enter into your PRL. PRL it should go. There is no concept of pre-acquisition dividend, post-acquisition dividend and all. Sir, but consolidation of pre-acquisition dividend is there, no sir. At the consolidated financial statement, the separate books, in that it will be there. Standalone books, dividend is always a income. It has to go only to PRL. That is second part. Then, there is some more discussion, examination point of view, not very worthy, but still it's a small discussion, only quickly we will cover it off. What is this is, there are some entities which are called as investment entities. Investment entity means you understand something like a mutual fund. Explanation is there in 110 standard. In the theory part, 1 page it is covered. You can go through it, easy only. So investment entities, what is their job? Daily they will buy shares in some company, they will hold it for some time, again they will sell it. Their goal is what? Capital appreciation or interest income, dividend income, these are their goals. But in the process what happened is, I purchased shares in some company, some startup company. My intention is to hold it for a period of 1.5 years and sell it off. But coincidentally what happened is, whatever shares I bought, that made me a major shareholder there. Since our investment entity became a major shareholder, I am in a position to control that company also. So I am a parent, that company is a subsidiary. But my intention is never to run that business. My intention is never to sit on the MD chair and talk decisions about how to do pharma business. I don't know. I am an ordinary investment company. I am a financial researcher. I know where to invest, but I don't know how to do pharma business, electricity business. I do not know. But coincidentally, I become a major shareholder in that company, and I am a parent company now. What Ind AS 110 says is, you are exempt from consolidation. Why? Even though you are having control on that company, your objective is not to run that business. Your objective is to hold this equity investment for some time and sell it off for a good gain. That's the goal. With that goal you purchased, so you are exempt from consolidation. Since you are exempt from consolidation and anyway you are going to sell off these investments in near future, in the balance sheet, you don't have 3 choices as discussed. What are 3 choices? Cost, FATPL, FAT are 3 choices you will not have. You will have only 1 choice. Guess what? FATPL. Why FATPL? Sir, this fellow is an entity like a mutual fund, sir. They're definitely going to sell off that investment. When anyway you have sell intention, obviously you should follow FATPL. Are you understanding, sir? This is one exemption. An exemption related point is given. Now what happened is, I am an investment entity. Last 5 years I am investment entity. Today I changed my business model. As a result, I am no more a investment entity. Since I am no more a investment entity, till last year, whatever exemption I got from consolidation, that will not be available from the current year. If somebody is my subsidiary, I definitely have to do consolidation. So I have to prepare consolidated financial statements also, separate financial statements also. In separate financial statements, I have 3 choices now. Till last year, I was having only 1 choice, which is FATPL. But you are not doing any consolidated financials. Now, SFS also you have to do, CFS also you have to do. And SFS again you will get how many choices? 3 choices. Suppose I want to follow FATPL. A big deal. Till last year also you are following anyway FATPL. Now also you will follow FATPL. That is easy. No sir, I want to follow FAT OCI. Anyway your investment in your balance sheet is appearing at fair value because you are following FATPL. Now also it should be appearing at fair value only. Only thing is, hereafter whenever you fair value, gain or loss will not go into PRL, it will go into OCI reserve. Very obvious. Or I want to follow cost. I want to follow cost. I don't want FATPL, I don't want FAT OCI. What our standard says is, the fair value of the equity investment on the date of change in status from investment entity you became a non-investment entity. On this day when fair value is there, a fair value must be accepted as deemed cost. Just because cost option is available, cost means actually what you paid 5 years back, at what rate you purchased it. Don't bring that. Do not bring that. Whatever is fair value today on the date of change in the classification, our fair value must be understood as a deemed cost, and hereafter you will never fair value it. So that discussion is there. Sir, reverse also possible. What is reverse? I am a non-investment entity. I am jumping now or changing my status to investment entity. My new method of full clarity I have now. What is that? I don't have a choice now. I have to follow FATPL. But my old method, I would have followed one possibility, cost. So in my books, investment is appearing at cost, but hereafter I have to apply FATPL. First and foremost thing what you have to do now? Fair value. Gain or loss will come. Where will it go? PRL, very nice. All these days you followed FETOC. Number no change will not come because that is fair value. Only thing is hereafter I will follow FETPL. But what will happen to it is recycled now. This is very important, and this is the only case where investment in equity shares measured at FETOC and OCI reserve is going to your recycling permitted. Sorry, you told Ind AS 109 it's not permitted. It is not Ind AS 109. Ind AS 109 is not applicable for this investment only. Scoped out, no, separate rule. So entire Ind AS law, this is the only case where investment in equity shares measured at FETOC can be reclassified from FETOC to FETPL, and the accumulated gain or loss till date is transferred to PRL, not retained earnings. This is the only case, sir. MCQ important. Normally 109 does not permit it. This standard permits it. The other case is a joke only. Already I am following FETPL, hereafter also I have to follow FETPL. Other than this books, nothing is there. Some small reorganization case example is there, but for that nothing much is there. That you can go through it easy only, that is. This is very rare case, sir. With that we are done with Ind AS 27.